Hi, everyone. We have to get out of here at 12:30, so we're going to move right along. Most of you know Sean Higgins. He is working at the CEQ Institute as director of the data center, is that right? And he's a well-known friend to all of us working on CEQ. So with that, let's just start. Let's get started.
Well, thank you, Gabriela. I'm excited to be back at the World Bank again. This has been kind of a long-term partnership and collaboration between the CEQ Institute and the World Bank, going back, I think, over 4 years now, back to the beginning of 2013. So I'm excited to be back. A rough agenda of what I'm going to go over today. I'll start with a brief introduction to CEQ, just about 20 minutes. To recap, maybe for anyone who's not quite as familiar with it, actually, it'd probably be a good idea to get a show of hands who is at least familiar with the methodology of CEQ. Okay, good. I was going off the assumption that everyone's at least familiar with the methodology, and who is in the process of working on a CEQ assessment. Okay, good. And who's completed a CEQ assessment for a particular country. All right, so we have a lot of experts in the room, which is exactly what I anticipated based on what Gabriela told me. So after the introduction, I'm going to go through what's new, some recent innovations in CEQ for a little under an hour and a half. Then we'll take our coffee break, and then I'll spend an hour and a half going over the CEQ Stata package. Since most of you have used the CEQ Stata package, it's going to be a focus on some things, the newest commands, as well as some tips for example, which commands should you use first when you're first starting to construct the data set, which commands should you leave later for the more advanced analysis. So to start with a brief description of CEQ, our mission at the CEQ Institute is to work to reduce inequality and poverty through comprehensive and rigorous tax and benefit incidence analysis and active engagement with the policy community. To achieve that, our objective is to measure the impact of fiscal policy on inequality and poverty across the world using a comparable framework. We have 4 work streams at the CEQ Institute. The first is research-based policy tools. I'll go through kind of what's covered under each of these work streams in a minute. The second is the data center. The third are our advisory and training services. And fourth, bridges to policy. And I should mention our main funding source was a recent $5 million grant from the Bill and Melinda Gates Foundation for 2016 to 2020. So the CEQ handbook, we just posted the revised version online in June. That's kind of finalized because it's now gone off to the editor. So you can access all of the chapters, open access online, and then that'll be published in hard format, if anyone still uses those these days, by the Brookings Institution in the fall. The handbook has 4 sections. The first, we cover the methodology. In the second, we cover implementation. So the chapters in implementation are, for example, kind of a description of each part of the CEQ Master Workbook, a description of how you can fill out the CEQ Master Workbook. So it's really a how-to guide. And then it also gives a description of the CEQ Stata package in that section. Third, we have applications, where there's a number of country case studies. And the nice thing about these country case studies is that they don't just like do CEQ assessment country by country, but rather each one kind of focuses on one particular part of the methodology that would be useful to a user of the handbook. So, for example, Iran showcases the CEQ effectiveness indicators. Each country showcases kind of a different aspect of the methodology. And then finally, our tools, which is they're not chapters, but they're the kind of online appendix, if you will, to the handbook. That includes the Master Workbook, which is a set of Excel spreadsheets that you all probably know very well. The CEQ checking protocol, kind of a description of what quality control we go through once we get results in the Master Workbook, and finally the CEQ Stata package. I should also mention, if anyone has questions, please do jump in and interrupt me as I go. The data center, in the data center we have data on poverty and inequality across income concepts in 30 countries. So the 30 country results can be downloaded already from the data center on the CEQ website. The future of the data center, which is one of the things I'm working on, first we want to expand the indicators. So that set of results for 30 countries right now is poverty and inequality across the income concepts. There's a lot more indicators a lot more results we produce at CEQ that we want to add into the results available through the data center. Of course, we're always we're always working to expand the country coverage, because particularly we've seen that policymakers really like to be able to see, how does my country compare to other similar countries? So the better the country coverage we have in the CEQ data center, the better we can do that. We're also working on interactive graphs programmed using Tableau, which can help people kind of visualize the results in the data center. And then for the countries in which it is possible, and we know due to various data agreements that this isn't possible in a lot of countries, but for the ones in which it is possible, we want to post harmonized microdata, sort of like what LIST does for mostly developed countries, where you can go in and access the household level microdata with the same variable names across countries. So that would allow, for example, a researcher to go in and do cross-country analyses using this rich microdata. And then we would also use, and if you want to see kind of, there's been tons of research, for example, using the LIST database, so we envision something similar available for developing countries. And you could also use this to, there would also be the code to convert the raw microdata available from the government to the harmonized microdata and the code to produce the CEQ assessment. So what that would do would allow others to, they could go in and say, maybe I don't agree with a certain assumption the research team made. I could see what the impact of changing that assumption would be, which increases our research transparency and allows others to replicate our results. In the advisory and training work stream, the main thing is events like this. I should mention that this mini training was offered at no cost to the World Bank, meaning that my time and travel were covered by the CEQ Institute. And that's part of the CEQ World Bank agreement that's in the process of being signed. We've done 2 or 3 day trainings at the World Bank a few times over the last few years that have been attended by both bank staff and governments, for example, Ministry of Finance from Indonesia and the Treasury from South Africa. We've also done trainings at the Ministries of Finance in Ghana, Paraguay, and Timor-Leste. We've done trainings at the Inter-American Development Bank and the European Commission, and at the World Bank country offices in the Dominican Republic and Senegal, which were also attended by policymakers from the Ministry of Finance, Central Bank, Ministry of Development, and the National Statistics Office. And then finally, for our Bridges to Policy, we have research collaborations with many of the multilateral organizations, as well as the OAS, the Center for Global Development. Our director, Nora Lustig, is participating in the G20 group on global financial governance, and participated in the World Bank Commission on Global Poverty, and a number of other kind of high-level expert groups. And she's able to bring to the table to all of these discussions results from CEQ. So one big example was we had found that in a lot of countries, a number of the poor pay more in taxes than they receive in transfers. They're fiscally impoverished. And so when they were discussing the Sustainable Development Goals, there was a lot of discussion about resource mobilization within countries, kind of how do you raise the resources to achieve these goals? And she was able to bring those results from CEQ to the table, which is something to keep in mind as policymakers are considering, how do they raise revenues to achieve the Sustainable Development Goals. And then with the IMF, we're working to have Article 4 and IMF program reviews, which have been completed for Costa Rica, Guatemala, Togo, and Zambia, are in process for Nigeria and Swaziland, and soon to begin in Benin and Tajikistan. So for the CEQ assessments, within the CEQ Institute, we're working on over 40 countries, which cover around 2/3 of the world population. And as I said before, we have results for 30 of the countries available in the data center. We have non-resident research associates and over 100 collaborators. As you all know, the results are utilized by governments. On our website, we also have a working paper series, and we have numerous scholarly publications in a variety of journals. Here's a map of the countries that have been completed within the CEQ Institute. The blue ones are ones that are already complete, and the results from those are available in the data center already. The ones in orange are in progress. And then many of you have also worked on ones kind of separately within the World Bank. So here we have a list of all of our partnership with the World Bank. A number of countries have been direct partnerships with the CEQ Institute, including the original 6 that Gabriela kind of started, that kind of initiated the partnership with the World Bank. And then we also have the ones on the right, about 30 countries that the World Bank is working on internally, and a number of them, the ones with asterisks here, are in collaboration with the CEQ Institute or with a CEQ Institute team member as a consultant on the team. So many of you know kind of the data information and software requirements of a of a CEQ assessment. I'll just go over it quickly. You need a household survey, ideally representative at the national level and the most recent one available. To estimate the indirect effects of indirect taxes and subsidies, you need an input-output table or a social accounting matrix, preferably of a year close to that of the household survey. You need a detailed description of each tax and spending item to be included in the analysis. And you need budget and administrative data for the year of the survey. As you know, we collect kind of very detailed budget data for the analysis. And then on the software side, you need Stata 13 or higher. The very first 13.0 still had some bugs in it that they fixed in later updates, so make sure to use update all in Stata. What that'll do is bring it to the most recent, so from 13.0 to 13.2, I think it is. And then to export graphs directly to Excel, a few of the commands create graphs. If you want to be able to export those directly into the master workbook, we need Stata 14 or higher because Stata updated the command that we used to do that automatic exporting. It wasn't possible before Stata 14. But with Stata 13, you can still produce the graphs, and then it'll save them for you on your computer. It just won't automatically export the graphs directly into the master workbook. So to give a very brief overview of the income concepts, these are just a few, kind of a very brief diagram showing what we do across income concepts in CEQ. We start with pre-fiscal income, which can be market income or market income plus pensions, depending on the scenario. We add direct transfers and subtract direct taxes to get to disposable income, add indirect subsidies and subtract indirect taxes to get to consumable income, and then we add the monetized value of public services in education and health to get to final income. And we currently include a number of fiscal interventions. I'd be interested to hear if anyone in their country studies have added any additional ones that we hadn't incorporated in the methodology thus far, because often we find that it depends, once the discussion begins with policymakers, they may have a particular interest to see something that we haven't included in the framework so far, and then those kind of get added in along the way. So right now we look at direct taxes, direct cash transfers, non-cash direct transfers such as school uniforms and lunches, contributions to pensions and social insurance systems, indirect taxes on consumption, indirect subsidies, and in-kind transfers such as spending on education and health, which are valued at government cost. And we have a number of allocation methods to assign these within the survey. Ideally, you would have direct identification from the survey if there's a direct question about, for example, a particular transfer program. However, we should mention these results must be checked to see how realistic they are. So occasionally you have a case where something looks very, the response to a survey question looks very unrealistic, and you'd want to figure out if it's usable. An example of that was in Bolivia. One of Bolivia's surveys, we saw that the value of own production was very strange and made poverty extremely low if you included the value of own production question from the survey as part of market income. And then if information is not directly available in the survey, we would use inference. So one example of this was the Aruna Tilake and Chauste and Lustig study in Sri Lanka. So the survey in that case lacked a question to identify who attended public versus private school. So they used questions from the consumption module on whether the household paid facility fees to government schools or private school fees, and that was a way to infer whether the student was attending public school, in which case we would assign them the public school benefit, or private school. Then we also have imputation. So an example of, there's many examples of imputation. That's just when you have some information from the survey, but not also the benefit amount from the survey. So for example, we impute the benefit often of school lunch. We know from the survey who receives free school lunch, but we don't know, the survey doesn't have a question, how much did you receive, because people wouldn't know the answer to that. And so then, you could take the total program cost, divide by the number of people who receive it, and impute that to each individual. We also have simulation, which is what we do for direct taxes in many countries, as well as transfers in some cases. So for example, the recent Argentina study by Rossignolo used simulation for direct transfers. And actually in that case, we had a discussion because you would think that, so they simulated it without assuming perfect coverage and targeting. And initially you would think, well, that's going to way overestimate the impact of this cash transfer. So then I went back and did it in Brazil, compared the simulation with perfect coverage and targeting to what we actually observe in the survey. And actually, they didn't give you very different answers. that's conditional, I should mention. In the survey, we do this correction method for the underestimate of the number of beneficiaries, where we impute benefits to additional similar people who didn't report receiving benefits. Once you do that you get a very similar answer to if you were to simulate perfect coverage and targeting, which I was surprised by, but we do know that these programs are fairly well targeted.
Yeah, but that will depend on the country.
Yes,
so
definitely.
I wouldn't extrapolate to other situations.
Yes, that's a very good point. And that should be our motto for many things. Is it will depend a lot on the country context. Then we also have prediction. So an example of prediction in the U.S., we didn't have whether people reported public or private, or whether they attended public or private school in the main survey. So what we did was we went to an alternate survey where we did have that information. We used some covariates common to both surveys to predict, conditional on being a student, would you attend public or private school? And then we used those regression coefficients coming back to our main data set to predict each student's probability of attending public school. And then finally, we have an alternate survey. So an example of this was from Indonesia. Yalemo, Waipoy, and Afkar used an alternate survey when they didn't have, I see people smiling. Did I pronounce it wrong? No? Okay. Yeah, I know. We met at the original back in 2013, I think. So they didn't have information on the main CCT, but another year they did have the information on the CCT, so they just used that information from the alternate survey, the distribution by, I think it was by some sector, chopped up the income distribution, and then by region as well, and then used that kind of to impute back into the main survey. And finally, we have secondary sources. I want to emphasize this is really a last resort. So in some countries early on, they said, we don't have like tax information in the survey, so we're just going to use a secondary source that says the distribution of taxes by decile. But we don't want to do that. So that's really a last resort. If you really can't find anywhere else, you shouldn't just use it as an easy cop-out to avoid having to do one of these other methods. The questions we answer in a CEQ assessment are how much income redistribution and poverty reduction is being accomplished through fiscal policy, how equalizing and pro-poor are specific taxes and government spending, how effective are taxes and government spending in reducing poverty and inequality, and what is the impact of fiscal reforms that change the size and or progressivity of a particular tax or benefit. So to wrap up this introduction to CEQ, I'm just going to show you an example of the kind of graphs and results we produced to answer the first question. And then we'll jump into the innovations in CEQ. So this first graph just compares across countries the composition of social spending, broken down into direct transfers, education, health, other social spending, and contributory pensions. You can see a few interesting things in the graph. First, there's a lot of variation across these developing countries that we've looked at in terms of the total percent of GDP spent on social spending as well as its composition. You can also see, for example, the farthest bar we have is the OECD average. You can see that some of these developing countries spend as much as the OECD average, so Argentina and Brazil, for example. And again, there's like a very big variation. Some are spending a lot on contributory pensions. Others are spending almost nothing on contributory pensions, but a lot on education and health. So this can be an interesting kind of first take to see where's the spending going. Now let's look at how inequality evolves over the distribution over the different income concepts as we add direct transfers and subtract direct taxes. So it's kind of hard to see what's going on because South Africa has changed the y-axis here. They have a very unequal market income distribution, but you can see that in South Africa, for example, they both redistribute a lot with direct taxes, so they reduce inequality a lot there, and then they also reduce inequality a lot from the education and health spending, but they start at such an unequal point that they're still very unequal with final income. And then you can kind of look at how this story evolves for any particular country that you're interested in. And then finally, how does fiscal policy affect poverty? These are results using the $2.50 per day line in PPP per day. And this is where we're treating contributory pensions as deferred income, so they're not counted as a transfer. And you can see that in some countries, poverty is higher after you add transfers and subtract all these taxes. Often in countries that have particularly high indirect taxes, for example, this can occur. And then And then over here you can see a lot of countries reduce poverty by quite a bit, adding all the direct transfers, indirect subsidies, and indirect and direct taxes. Okay, any questions on this overview of CEQ? I think most of that was familiar to everyone, so now I hope some new material starts emerging in this next section on what's new and the recent innovations in CEQ. So here's an outline of what I'm going to talk about on these recent innovations. First, I want to talk about the treatment of contributory social insurance pensions, because we've had kind of a lot of methodological, theoretical discussions on this. As CEQ has evolved, we've tried, consulted with various experts, tried to figure out how should we treat pensions. We convinced the OECD that they were doing it wrong, but we've also kind of recently finally refined, okay, what is the theoretically correct way to do it, and then how does that map into the CEQ Stata package and the master workbook and the results that we present. So I want to present that so that hopefully it kind of is clear for everyone. Then I'm going to talk about fiscal impoverishment indicators and effectiveness indicators, which are two indicators that were created for CEQ assessments. I'm going to talk about some work we're doing valuing health and education benefits using other approaches than the current approach, which is to value it at the cost of government provision. And finally, I'm going to talk about some ongoing work we're doing on how to correct for underreporting and undercoverage of top incomes. So for the treatment of contributory social insurance pensions, we have these kind of two options. We can either treat pensions as deferred income, or we could treat them as a government transfer, or maybe something in the middle, where part of the pension is a government transfer, for example, if the system is subsidized. So two extreme scenarios, which are the two we produce at CEQ, so you can kind of see the effects of each end of the extremes, are to first consider pensions as deferred income, and if it's deferred income in an actuarially fair system, then these pensions should be included in the pre-fiscal income concept, and contributions treated as mandatory savings, just like any other savings that you make out of your income. And so hence pre-fiscal income should be net of those contributions. And I'll talk about why in a little more detail on the next slide. If they're treated as a government transfer, on the other hand, then we want to include pensions among direct transfers, so they're not included in the pre-fiscal income concept, but they're added in as we go through the fiscal interventions. And we're going to want to treat the contributions to that system as a direct tax. So hence the pre-fiscal income should be gross of contributions, and those should be subtracted out as we go. All right, so let me talk about the issue that led us to these conclusions, and in particular the conclusion and what changed relative to our old version of the handbook is that pre-fiscal income should be net of contributions in the pensions as a deferred income scenario. And the reason is that if it's not net of those contributions, then we're actually double counting those contributions. So to think about this, let's think about an individual who we observe at working age, and then that same individual in a future survey at retirement age. Or you can think of the same, a working individual in the current survey and a retirement individual. We shouldn't be counting the contributions as part of income. We shouldn't have our income concept be gross of contributions for both of those individuals. Otherwise, for a particular individual, we're both counting that as part of their income now when they're saving it, and as part of their income in the future when they're receiving those pensions. That's the double counting issue. So if we call factor income during your working years Y, factor income during retirement years is going to be 0. Contributions are going to be paid at rate S on your income. And then it's going to be an actuarially fair system. You just receive exactly what you contributed, S times Y in retirement. For simplicity, I'm going to assume 0 interest here. And then we have total direct taxes T and benefits B, or T prime B prime in retirement. So in this little table, I just basically reiterated that, except now I'm going to ask the question for pre-fiscal income at working age. We know that your factor income was Y, your contributions were SY, and then the question is, do we leave those contributions in income, so is pre-fiscal income Y, or do we subtract them out and have pre-fiscal income net of those contributions, so it would be 1 minus SY. And you can see in this little table, it becomes obvious, and which is partly why I'm surprised it kind of took us so long to reach this conclusion, but partly the blame's on me because I was in those discussions. If you look at this table, it's kind of obvious. It was actually Chico Ferreira who we've kind of finally sat down with, and he drew up a little table similar to this, and then we realized, oh, there definitely should be net of contributions. So like if we chose Y, then it would still be gross of contributions, SY, so you're double counting that SY. So we need it to be 1 minus SY in the working age population and SY in the retirement age population. And then to get disposable income, you just subtract taxes and add benefits on top of that.
This I think is important for those of you who've done CEQ before, and for those of you who are starting a new CEQ, the way the handbook is currently written is very confusing. You don't understand what's going on. I know this because people who have been reading the handbook, the new handbook, have been very confused. So in the old days, when we talked about market income would not subtract away pension contributions, right? It's kind of weird to say, because your first instinct, which is what CEQ was originally doing, is just wages and salaries, right? Private transfers, that would be your market income. You wouldn't think I have to subtract away contributions to Social Security to get to a real measure of initial income, right? Nobody was thinking that. But that's essentially what they're saying, is not from now on, the deferred income scenario of CEQ should subtract away any pension contributions to the Social Security system. So is that clear? So I think it's important. You don't realize how important, how big this is unless you work with a country where pensions are huge. So I faced this for the first time in Poland, where pensions are humongous. The contributions are, 17% of annual income, this sort of thing. And in those cases, taking away 17% is a lot. It's a lot to take away, right? No matter where you do it. So it's important to figure out when you do it and where you do it. It also makes the point that for those of you who have done the CEQ in the old version, it's no longer comparable to the new CEQs, because obviously our market income concept is going to be different. And so that's why they're very keen on getting our data and getting us to rerun some of those numbers, because at least for this scenario, they're no longer comparable for that if you're looking at things relative to market income. So I don't know if that helps. This is the time to really ask questions, because if you read the handbook, this part doesn't become crystal clear unless you really focus on what's going on. So you're basically in the deferred income scenario, you're taking away the contributions, even at market income. You're taking them away everywhere, so that you don't double count. Because otherwise, you're basically taking those savings, right? You're assuming these pensions are savings. You're counting them first when you're a young worker and you're saving the money, and then again you're counting them when you have retired and you're dissaving. This ensures that doesn't happen. Is that right?
Yeah, right. And I'll also get to the kind of income concept diagram in a second. I think that even as recently as a year ago, we were still doing something somewhat confusing, which was asking people in both scenarios to generate a market income and a market income plus pensions concept, which is part of, I think, where the confusion came from. So we've fixed that, and I'll explain it when we get to the income diagram in terms of what.
Yeah, but for some of us who have been doing multiple rounds of CEQ, some teams who are updating over and over, it's important to sort of say, okay, this is what was done before, this is what we're doing now, and this is how they're different. Because obviously, a lot of teams were lost in the transition, and what's comparable and what's not comparable, and sort of going forward where this thinking goes. I think there's kind of a lot of back and forth. Even, myself, I remember sending something like this to Nora and team, saying, well, wait a minute, we're double counting. This is big. And we had like some toy exercise and so on. But it took a while for you guys to come back and say, yeah, you're right. This is the way to do it. And so some teams, I know the Russia team, for example, had tried alternatives to what you're now calling the benchmark and the sensitivity scenario. And so making clear, okay, let's just agree this is going to be what it is and why you came to that.
Right. Yeah. So is it unclear for anyone why we need to subtract out the contributions before generating pre-fiscal income in the scenario where pensions are deferred income. Yes. So the question is it unclear why? So here you can see that in pre-fiscal income, which in this case is going to be the market income plus pension scenario, your pre-fiscal income is net of contributions to the net of contributions to pensions. So it's 1 minus SY. Previously, in old versions, I would say we had this fixed in the version of the handbook we had that we talked about last summer here at the World Bank, but in versions prior to that, it was different. So now we're saying you should always subtract out contributions to pensions in the pension as deferred income scenario. So basically, every income concept you're generating in the pensions as deferred income scenario is already net of contributions to pensions. And the reason is if it's not net of them, then you're double counting, because then you would have Y under the working age for pre-fiscal income. You would just have Y, the entire income. You wouldn't have subtracted it out. And then in retirement age, you would have SY, so that SY, the portion being contributed, is being double counted. It's being still counted in the incomes of the people of working age because we're not subtracting it out, and then it would be counted again when the people of retirement age are receiving it. So that's the double counting issue. And in the old version, so a year ago version of the handbook, in the pensions as deferred income scenario, we never subtracted out those contributions. So disposable income also would still be different than, so first of all, disposable income between the two scenarios was different. And this, I think, was what kind of generated the conversation with Gabriela, particularly when Sri Lanka was doing the mapping to consumption, is when the issue came up. But disposable income, there's no reason it should be different across the two scenarios. And now this also fixes that, because in the pensions as deferred income case, your pre-fiscal income would be net of contributions. In the pensions as government transfer case, your pre-fiscal income would still have the contributions. I think I have that here. But you subtract those out before you get to disposable income. You subtract them out along with taxes. So then disposable income is the same in both scenarios. So this second table is showing you the pensions as government transfer scenario. So in that case, contributions are not subtracted out of your pre-fiscal income. So your pre-fiscal income is the whole Y, but the pre-fiscal income from retirement age, since we're considering pensions as a government transfer, we haven't counted those yet. So it's 0. So we're not double counting at the pre-fiscal income stage. Then when we move to disposable income, we subtract out the contributions to pensions, just as we subtract out taxes. So that's why in this first row for working age, you see 1 minus SY. So now we've subtracted out the SY, the contributions, when moving from pre-fiscal income to disposable income. And then for the retired, we add in the pensions when moving from pre-fiscal income to disposable income, and that's where we've added in SY there. And what you can see if you compare the table from pensions as deferred income, the disposable income column, to pensions as government transfers, disposable income is the same in both scenarios, as it should be.
Yeah, so that's nice, right? The disposable income is now the same no matter how you treat pensions. That's different from, those of you who were doing this 3 years ago, because before it was different. They were different. Everything was different. Now, your disposable income is going to be identical. The only thing that's going to be different is the market income concept. That's the only thing that's going to be different. And now, why does that matter? It matters because if you're looking at direct taxes, for example, what is the right income base to think about direct taxes? How should you measure them? We usually measure them relative to an original income, right? The original income will be, in this case, either market income or market income plus pensions. And so if you're measuring, for example, a Kakwani, to look at progressivity, look at how does the direct tax impinge on different portions of the distribution relative to your market income. But which market income? Is it the market income plus pensions or in the deferred income scenario or not? So that's where it's going to change a little bit depending on which scenario you're looking at. So it's the market income that's different. Is it clear? I know there are some people here who haven't done any CEQs, so this is all new and it's a little bit maybe too fast. But so it's important to sort of think through, well, why do we care? Why do we care if it's deferred income. In a low-income country setting, like an African country setting, where pensions are very tiny, it may not make that big of a difference. If you're working on Namibia or South Africa, it makes a big difference. Or, a place where any country where there are significant pensions, it makes a difference.
And it makes a difference also in terms of the narrative that you're going to be telling policymakers. So Gabriella and I were reviewing the Latvia CEQ recently, and there was a debate over how it should be treated. And you either go from a story of Latvia as one of the most redistributive countries in the world, because it was all being achieved through pensions, or you go to one where it's actually, if you take this out from market income in the first place, it's relatively equal to begin with, and then the fiscal policy doesn't do much to change that position. Or it's moderately unequal and becomes quite equal as a result.
Yeah.
And it's a huge difference either way. And so you always kind of want to highlight what you're doing on this one, which decision you've made, and to show the alternative, to show how much of a difference it's going to make, because it's a critical decision for countries with large contributory pensions.
Especially in ECA, there's a whole now, many of you working on ECA are aware, there's a whole discussion around the social contract. What is this social contract in ECA, in a society where most of the transfers, most of the fiscal sort of effort is happening through pensions because of an aging society and everything else? And is that the right kind of method, especially in countries where the pension system is not sustainable, and it feels more like a transfer as opposed to a savings? So I think Sean will also go through that scenario where you're kind of in the middle. Half of it is contributory, the other half isn't contributory, and you're somewhere in the middle. But if you don't get these two extremes to begin with, then the whole policy discussion is sort of meaningless. So it's important to sort of, latch on to this. Go ahead.
Just a clarifying question. Is there one method you pick over the other? How do you decide which one? Is it?
No. So usually what we do is we do both. And you may want to even do the 3 scenarios. Because you want to be able to tell the authorities, look, if you take your pensions as transfers, as a cash transfer, then this is what your system is doing. But if your system is more really like people are actually contributing, and when they retire, they will only get the portion that they've contributed, like a saving, then that looks very different, especially if the contributions were large, right? It's like forced savings. So in those cases, the redistributive portion is actually going to be very small, right? It's only going to be whatever in excess of pensions is going on. Usually, direct transfers, direct cash transfers, that sort of thing. So it really matters a lot, the country context in which you're working in, but how you look at this is, in a way, sometimes you can't really tell, right? It's partially one or the other, and figuring out how, what part is which, that's the hard part. I mean, theoretically, he'll show you what to do in this intermediate scenario, but actually figuring out what to put in which pillar is actually not easy.
So my first question, I think you touched upon it when you spoke about the fact that maybe the disposable income doesn't change much. So I was going to ask if you can give an illustration based on some of the work that you've done on how the old method and the new method, how those two compare. And then to say, is there some kind of a rule of thumb to say the old method underestimates or overestimates the different poverty and inequality indicators?
Yeah, that's a very good question. So as Gabriela mentioned, it depends a lot on whether pensions are large in the country. So in both the old method and the new method, we asked people to do the 2 cases: pensions as deferred income, pensions as government transfers. The pensions as government transfers case was identical in both the old method and the new method. What differed was that in the pensions as deferred income case, we were not telling people that here in pre-fiscal income, they should be subtracting out the contributions. So the difference between the two was for both market income as well as disposable income in the pensions as deferred income scenario in the old method, those were not net of contributions. So they still included the contributions, which means, so for example, as far as poverty, in the new method, your incomes are going to be lower because we've subtracted them out. So poverty would be higher, and how much higher is going to depend on how big pensions are in the country, which determines how big contributions are as well. But it's also worth noting that in the old method, we had them not subtracted out from all of the income concepts, and then the new method for pensions as deferred income, they are subtracted out from all of the income concepts. So it'll affect the level that you start at, but it shouldn't really affect the effect of fiscal policy on inequality and poverty.
Yeah, I guess the other good thing to note is that in the scenario where we had pensions as transfers, even in the old method, that's exactly the same. That has not changed. And the good thing about that is that there are other institutions who also have a pensions as transfers kind of measure. So like if you want to compare to Euromod or you want to compare to, I'm not sure about the OECD.
Yeah, so they had traditionally always treated pensions as transfers,
Okay.
and then we convinced them to produce both as well
Right.
recently.
But at least for the old data and our old results, those are comparable for pensions as transfers, even in the old way of doing this. I think the big thing that has changed is the deferred sort of pensions as deferred income, which used to be called the benchmark scenario, and that's the sort of the one that we were using for cross-country comparisons for CEQ. So now that's a problem, because if these studies were done in the past and haven't been updated, then there's a worry that we're comparing apples to oranges.
Yeah, and actually it's worth, we haven't done this within CEQ, but it would be worth doing for some countries, seeing actually how big of a difference does it make, because we could go back to the old studies, simply create the new income concept, and I'll show you a command once we get to the CEQ data package called CEQ Assump that makes it very easy to just quickly see what are the summary indicators, inequality, poverty, distribution by decile, for example, for different income concepts. So here we could go in and use that CEQ Assump command to just see, okay, how does subtracting or not subtracting out the contributions in this pensions as deferred income scenario change it. And I should also mention on Gabriela's point about the names, the reason we changed it, so it used to be that benchmark case was, or the benchmark scenario was pensions as deferred income, and then we called the pensions as government transfers a sensitivity analysis, but we figured maybe we shouldn't be taking such a strong stance on kind of which is the main one, because it varies country to country. For example, the policymakers might tell you, oh no, here really transfers are, pensions are considered a transfer. So we didn't want to take a strong stance on which was the preferred. We like to present results for both. And it's worth mentioning in all countries you should produce results for both, and that always, if you're comparing to other countries, you should make sure you're comparing, apples to apples. So if you're using the pensions as deferred income as your main scenario in a particular country, and then you want to do some cross-country comparison graphs, make sure you're using the pensions as deferred income results from the other countries.
Are you going to mark the countries for which they are being done? So if I go into the data center, will I be able to tell which ones for the pensions as deferred income, which ones are done using the new version, the new handbook, and which ones were done using the old?
Yeah, that's a very good question. I'll have to check with Minor, who's kind of in charge of those aspects of the data center, and we definitely should. So I'll make sure that message gets passed along. I know in the data center, we do have kind of a table that summarizes characteristics of each country, whether it's income or consumption survey and various methodological aspects. So that should definitely be one of the methodological aspects that we address. So now let me tell you what this didn't affect.
I have two more questions about pensions.
Oh, yeah.
So one is the general one. So does the CEQ team have any recommendations which scenario is still preferred one or like alternative one, or it depends on the country context? Because we had quite a discussion in the recent Belarus CEQ when, depending on the country context, we as a team believe that the pension as a transfers is more relevant to the country, while in the review process we're sort of told that there is a recommendation of CEQ team that pension as a deferred income is a more preferred scenario. So is this true or not? And the second is the more specific about the previous pension as a deferred income scenario. So you mentioned that contributions are treated as a savings similar to any other savings, right? Did I understand you correctly on this?
Yeah,
Then the question is, should we also adjust for any other savings? These savings are sort of issues not only for pensions, like bank accounts, life insurance, any other way, treating the savings versus these savings similarly to the pension stuff? Thanks.
Yeah, very good question. So on the first one, as far as I know, I'll have to check in the handbook and make sure what the exact language is, but now the reason that we changed the language was so that we weren't kind of giving preference to one over the other, because we did see a number of countries, like your example for Belarus, a number of countries where they really do consider pensions as a government transfer, and so we kind of wanted to stop. The reason we changed the names was to stop giving the main importance to the pensions as deferred income scenario. So I would say that I'll have to double check in the handbook to kind of check the language for sure, but I think we no longer give preference to one or the other. It really depends on the country context, and we present both scenarios.
I thought that depended a little bit on whether it was actuarially fair. So like in some systems where, younger populations, they set it up and you get these massive pension contributions which are being easily funded out of a young working age population. But once that working age population gets old and you lose it, it's clearly going to be an unsustainable system. In those cases, you certainly didn't really want to go towards a deferred income because the current system was not going to. But if the system was largely fiscally sustainable, I thought the default, your choice of whether or not you might change your mind based on how the government really wants to phrase it. But from a technical perspective, I thought the default was, if this is broadly speaking sustainable, that you went with deferred income. That's not the case?
Yeah, that is the case. So if it's I should say the cases where countries have come back and said, pensions as a deferred or the government's really saying that the pensions are a deferred or are government transfers here, are cases where it's more unclear, exactly how our pensions, like what source of revenues are pensions coming from. There wasn't this clear contribution and like a fairly close mapping between what you're contributing and what you get in old age. So the results I presented to you here, which maybe kind of give still our revealed preference, we're all using pensions as deferred income. Whenever I'm presenting cross-country results, those are the ones I present. So in that case, we do have a preference. In that sense, I just don't want particular country teams to say like, oh, we can't, kind of, if it's a particular country scenario where it seems like really pensions should be treated as government transfers because they come out of general revenues, there's no individual contributions, which happened in some countries. I don't want to say, or I don't think that this scenario should be happening where the review committee says, oh no, you have to do the main one as deferred income because that's what CEQ says. But yes, if there's a close, under kind of normal scenarios that we see in the majority of countries, we prefer to go with the pensions as deferred income scenario. If you treat pensions as a government transfer, there's also a lot of issues that come up. For example, like if you look at the OECD countries, it's very dependent on the structure of the age of the population, how redistributive a country looks. Okay, so any other questions? Yes, second question. Yes, so in theory, we should also do the exact same thing. So the same argument I told you about double counting for contributions to pensions also applies to private savings, because we're not subtracting out of your income your private savings now, and when you receive your private retirement income, we are counting that. So then we'd be double counting again. We thought about, can we subtract out savings? Because in theory, that would also solve the double counting issue. And we couldn't, a lot of surveys don't have good measures of savings, so it seemed not possible to do so. So we don't recommend subtracting out savings. Another issue with it would kind of get you to an answer that's very different than, maybe very different from like the kind of government poverty statistics that everyone's used to seeing. But the main issue is just the data limitation, that we don't have good measures of savings from our surveys. But I should also mention that if you're using a consumption-based survey and then generating the income concepts where you say, okay, consumption equals disposable income, well, consumption is net of your savings. So in that case, you are using a net of savings variable.
Actually, for that, it would be useful to do a little bit of algebra to figure out, for yourselves, to figure out how to go from consumption back to market income under the two different scenarios. Because even though the answer is in the handbook, getting from just consumption to those aggregates doesn't make sense until you do the algebra yourself. So the teams that we've had struggled with this, also because the handbook, the way it's written, it's a little bit confusing. So unless you do the algebra, it doesn't kind of settle in your brain. Especially, I just noticed you're not going to cover this middle sort of scenario. And for that middle scenario, the middle scenario doesn't make sense unless you go through the algebra a little bit.
Right, yeah. So the middle scenario, the issue, and maybe people have feedback on this, is that it's we're still kind of grappling with the theoretical aspects of it, and so now, so the results that most countries have been producing are these two extremes. You could also think about a middle scenario where you say, okay, only a part of the government transfer, or part of the pension is a government transfer, and part of it is deferred income. So, for example, suppose the pension system is in deficit. So part of, let's say 25% of total pensions we know are paid out of general revenues, while the other 75% is paid out of people's direct contributions.
Most systems have a first pillar and a second pillar. And so first pillar is typically not contributory, and the second pillar is contributory. So for all of countries who have multiple pillar pension system, then that would apply.
So is that in those two pillars? Is it clear like some people are receiving from one pillar?
Yeah. So the first pillar typically is for the poor who have no savings, right? So think of a lot of most Latin American countries, I would say most European or ECA countries have these systems where the first pillar is sort of what they call the minimum pension, the sort of the minimum that you need to survive, that the government will pay even if you haven't contributed, right?
Right. So we do account for that. So we always treat those as a direct transfer. We call them the non-contributory.
Yeah, but
pensions.
if in the pension system, sometimes they're all mixed up. So you need to strip away and have that portion be explicitly a cash transfer, and only account for the second pillar in this way.
Right. No. So
and
yeah.
And the relevant contributions and everything you need to strip away. So it's
Yes, that we definitely want to do, and so basically in every country that we've done an analysis, we have non-contributory pensions, which are one of the fiscal interventions that's always part of direct transfers. And if it's this case, so in some countries it's very obvious which ones are the non-contributory pensions because there's a separate program name and everything, and they ask a question about it in the survey. In countries where it's not, we've used, for example, inference to say, okay, we know that pensions up to a certain amount are these non-contributory pensions, and then maybe there's a little bit of noise there because you could get a contributory pension that's that small, but most of the contributory pensions are larger. So we'll say, okay, any pension up to this amount, which is the cap on the first pillar, we're going to consider a non-contributory pension, and so we consider that a direct transfer. So we always try to separate out the non-contributory pensions and treat those as a direct transfer. For the contributory part, you could still have a deficit. So even if it's not for the poor, even if everyone receiving is, for example, contributed to the system over their working life, it could still be the case that there's a deficit, and this is the case in many countries, and so part of the pension benefits are coming from general revenues. So in that case, the kind of general idea of what you want to do here is treat a portion of the so instead of when you go from pre-fiscal income to disposable income, actually your pre-fiscal income would be the portion of the contributory pension that comes from that comes from the part that's not subsidized from the government. So let's say that 25% of the total pension benefits are in deficit. So then we could say, okay, 75% of the pension benefit that we observe you receiving in the survey is deferred income. And so we're going to include that. So your pre-fiscal income in retirement age would be 75% of whatever we observe you respond to the question of what your pension income is. And then the other 25%, because it's 25% of the total pension system is funded by general revenues because of the deficit, that 25% we're going to consider a government transfer. So how does that look? Well, in retirement age, in pre-fiscal income, we have 75% of what we observe as your pension income in the survey is your pre-fiscal income. And then when we move to disposable income, we add in that additional 25%. The part that gets a little complicated before we go to the question is that then what do you do with the contributions? So in this example that I just told you, where it's general tax revenues making up the rest, well, then we should still consider the entire contribution, just like we do in the pensions as deferred income scenario, because that entire contribution is going to the part that I'm getting back when I retire. So that's how we wrote up in the handbook what to do in this kind of middle scenario. But there's a lot of other cases where maybe it's not that it's coming from general revenues. There could be redistribution within the system, and those are the theoretical aspects that we're still that we haven't worked out yet. But you could do one where the system is in deficit, and I'll talk about it when I get to the kind of diagram how you would do that. The system is in deficit, so you treat part of your pension benefit as deferred income. You treat part as whatever the percent of the total of the deficit funded by general revenues is. You treat that percent of observed pension benefits as a transfer, and then you treat the entire contribution just like you would in the pensions as deferred income scenario.
So is the share, how much is treated as a deferred income, is it similar for the whole population, for the whole distribution?
Yes.
Because it could be very different, across the distribution. For low-income pensioners, it might be much higher, and for relatively rich pensioners, it might be much lower, obviously. And then you miss the whole point if you do it equal for the whole population.
Yeah, so those are precisely kind of the theoretical complications that arise, and we are doing ongoing work in that. That's one of Nora's priorities for some of the ongoing CEQ work, but we haven't been able to kind of, you have to make a lot of assumptions to be able to, well, we're making a very heroic assumption that it's a constant proportion across the income distribution. You would equally have to make a very heroic assumption to do anything else. So again, you could do, well, our answer to all of these is always do sensitivity analyses. If you think it's something else, you can, program that when you're generating what percent of each person's pension is a government transfer. You just want to ensure that then the total percent that you're saying is government transfers is equal to the total amount of deficit-funded pensions in the system. Okay, so let's see if we have any other questions about pensions, because as Gabriela said before, this is kind of the biggest thing that's changed over time that we need to make sure is very clear for everyone. So I guess, so it's the most important part of this morning. So definitely let me know if you have any other questions about it. The next thing to note on it is something that we changed very recently, but it doesn't affect how you define the income concepts themselves, and it won't affect your results, but it affects then how you kind of map that into the CEQ data package and the results in section E of the master workbook. It makes it simpler and easier to understand, I think, so it should be a welcome change, hopefully. What we were doing before, say as of the version of the handbook, not the original 2013, but what we kind of circulated a year ago and talked about last summer, was then we were saying, okay, in both scenarios, create a market income variable and a market income plus pensions variable. We realized that was not really accomplishing anything, and that we could, because, as Gabriela mentioned earlier, well, disposable income is the same now in both scenarios. Pensions as deferred income and pensions as government transfers. So then all the subsequent income concepts, consumable income, final income, are also the same. So really, the only difference we have is at the top of the kind of income concept flowchart. So when we're producing results, it's kind of a waste of space if we have to produce a whole set of section E results of the master workbook for both scenarios separately, because all the results for disposable income, consumable income, final income would be identical across the two scenarios. So we realized, why don't we kind of create a framework that allows us to capture both results in one set of section E results, and then in section D, which is the part that summarizes the results, we'll still have two sets of section D results, because that's where we maybe need to rank by the market income or market income plus pensions concept to calculate the Kakwanis, for example. So what we do now is we produce one set of section E results with everything that kind of captures both the results for the market or the deferred income and government transfer scenarios, and then the section D to E linking will pull those results into two separate sets of section D, one with all the results if the pensions are deferred income, and one if they are a government transfer.
I have a big request here. The automatic CEQ do file, maybe we'll get to this when we get to the do file, but it allows you to get sort of the automatic E to D linking, but it only allows you to do sort of kakwanis at the aggregate level, so direct taxes as a whole, indirect taxes as a whole, etc. But we like to look at intervention by intervention, and the only way to do that in the past was when we manually, this last year, for example, if I wanted that, I would manually do the E to D linking myself and not rely on the do file, because the do file wasn't generating the disaggregate. So if you're messing with the E file, which I think you are,
I'll explain what happens
in the output. We still are going to want to have a way to get to our customized kakwanis.
Yes,
intervention by intervention.
Right, you definitely still have that. So suppose you are saying, I want to do kakwanis where I rank the income distribution by pre-fiscal income. So you'll still have a sheet that has the kakwanis. So that set of results has different sheets where you ranked by each possible income concept. And so you'll still have one sheet that ranks by market income, which is the pre-fiscal income concept for the pensions as government transfers scenario. So if pensions are government transfers, you'd go to that sheet. I think it's the CEQ fiscal result command that produces the kakwanis. That would be on sheet E11. So you go to E11. There's going to be 8 sheets within the E11 Excel. The 8 sheets are going to be ranking by each income concept, because the kakwani coefficient depends on what you define as the kind of distribution by which you want to rank households. So if you're doing the pensions as government transfer scenario, you're going to go to the E11M sheet, because market income is the pre-fiscal income concept in the pensions as government transfer scenario. In the pensions as deferred income scenario, well, we're including pensions as part of your income, so your pre-fiscal income concept is going to be the market income plus pensions income concept. So then you're going to want to go to that. There's another E11 sheet called E11M plus P that's ranking by that income concept. So then you want to go there to get the Kakwani coefficients for the pensions as deferred income scenario.
So, Sean, can we just clarify? You're saying each of the different sheets is by the different income concepts, right?
Yes.
So, but it's not the case. If you've got 2 direct transfers and you want to look at their relative impacts, you can't distinguish them because they're both happening at the same income concept change.
So we still have kind of the maximum disaggregated, we call it the accordion feature, where basically it like expands the number of columns of results depending on how many, what variables you used in the command. That's all still there. So we haven't really changed any of the structure of section E. It's just that now, instead of saying produce 2 section E's and then we're going to focus, if you're doing the PGT scenario, we're going to focus on the results ranked by market income. If you're doing the PDI, we'll focus on results ranked by market income plus pensions. Now we say, okay, we'll produce 1 set of section E, and then still to know which sheet to go to, which income concept ranking we care about, depends on which scenario's results we're looking at.
In the past, you had to produce 2 Excels, 2 E-sheets, right? One was PD for one scenario, the other one was for the other scenario. Now they've put it into a single, am I understanding correctly?
Yeah.
To a single Excel file where you have more tabs within that Excel file, and it's clear what they are?
You don't even have more tabs, because before we still asked you in both scenarios
then market income plus
to
pensions.
do both options. So that's why we realized we were doing something that didn't make sense, and that we could kind of have it all in one set of E-sheets. And now you just need to know like which results you're going to focus on. So the D sheets kind of make it automatic for you. Here's the results you should focus on. But if you want kind of the disaggregated by program, the reason we don't have those in D is it's very complicated, since they don't have kind of standardized name. You might have one particular program with one particular name.
Just for the unexperienced user who wants that level of detail, Sandra had previously provided a very easy E2D kind of example where she had done, okay, if you want the Kakwani for personal income tax for country X, for this scenario, these are the 2 cells that you would pick to subtract, because that's all you're doing really is you have to know which cell to go and pick, right? So an example I think would be useful. An example from, I don't know, whatever country you like, or a made-up country even if you like, but an Excel format that would allow the user to customize because again, there's no other way. I mean, unless you can figure out how to program this in Stata, where the user can choose to produce all of the kagwanis, all of the marginal contributions for every single intervention in an accordion fashion, then this will be needed.
Right. So you could, I know that the results in section E can be overwhelming because of the kind of sheer amount of results, but I have also included options that try to say, like, limit the amount of results you give me, and it still prints to section E. So in theory, you could say, do the CEQ fiscal command, and if you wanted the kakwani for each concept only with respect to, let's say you knew you wanted to do the pensions as deferred income scenario, you wanted the kakwani for every single program, tax and transfer in the country, but you didn't want all the other results, you could do the CEQ fiscal command with only that one income concept option, the market income plus pension. So that would only give you that one of the sheets of E11, that one income ranking. And then you can also, there's options, so there's also kind of these disaggregated results by centile and all this stuff that you probably won't use. So there's also options for no centile, for example, to not produce all those results. So if you kind of look through the help files, I tried to make it so there are a lot of options that allow the user to like produce a limited set of results if that's what they want to do. But we don't have a way to kind of, at least right now, to pull that accordion disaggregated results where we're looking at each program in the country into the more kind of summary section D format, just because in theory we could probably come up with something that's a little difficult, like the D to E linking we have for overall categories, direct taxes, direct transfers, which do automatically get pulled to section D. That's easier because we've defined the names are fixed. Direct taxes, the name of that is not going to change. Whereas for the accordion, it depends on whatever the user labeled the variable as in their data set. So it might be, Bolsa Familia in Brazil is the name of that particular variable label, and so that makes it harder to do the linking. But it's also something we can look into. Any other questions about? Well, I'm going to explain a little more also how this maps to section E. But any questions? Additional questions so far? Okay, so to summarize how this maps to section E, just I'll go into this in more detail in the CEQ Stata package talk as well, so we'll come back to it. But basically, each CEQ Stata command asks you for the 8 income concepts, and you can specify any subset of those 8 that you want. But to produce the kind of full set of results for section E, you'd specify all 8, where you start with market income, and market income is going to be pre-fiscal income in the pensions as government transfers scenario. So it's going to we're going to have not subtracted out yet the contributions, and for those who are receiving pensions, it's going to not yet include their pensions. That's going to be this first income concept, market income. Then you can think about, okay, adding in the contributory pensions and subtracting out the contributions. That gets us to market income plus pensions, which is exactly the pre-fiscal income concept in the pensions as deferred income scenario, where we have subtracted out contributions for the working age population, and we've added, and it includes the pensions received by the retired. So that's going to be our pre-fiscal income concept in the pensions as deferred income scenario. So the reason, for example, in the other table you heard me saying pre-fiscal income rather than market income is that we're using the term pre-fiscal income to capture whatever is the pre-fiscal income in that treatment of contributory pensions, which could either be market income or market income plus pensions. Then we have these 2 possible paths. You can either add direct transfers first, which gets you to gross income. You can subtract direct taxes to get to net market income. And then you can do the opposite to get to disposable income. And we already know about consumable and final. So the kind of main message here is that you just produce one set of e-results using all 8 of the income concepts, and then you would go in and pick the results for depending on which scenario you're looking at. You would go to the appropriate sheet, for example. So if you're doing kakwanis, you'd go to the appropriate sheet. If you're saying what was the impact of the fiscal system on government on the income distribution, on inequality, let's say, well then you would go to the sheet. CEQ Lorenz has all the genies. You could go to that sheet, and it has different columns for each of the core income concepts. So in that sheet, you would say, okay, if I'm considering pensions as deferred income, I'm going to compare the Gini of market income plus pensions to the Gini of final income, let's say. But if I'm considering pensions as a government transfer, then I'm going to compare the market income Gini to the final income Gini. So that's the new kind of framework in the e-sheets, and I'll talk about exactly how that maps into the CEQ Stata commands in the next session today. All right, so we spent the most amount of time on exactly what was, I think, the most important to cover. So let me get a sense of these next couple are not exactly new, and they've been, I would say, at least like the last year and a half, nothing's changed about them. So let me get a sense to how familiar, I want to get a sense of how familiar people are with first the fiscal impoverishment indicators and then the effectiveness indicators to see which would make more sense to focus on. So actually, let's just do a vote of, I'm going to briefly go through each, but I'm going to spend a little more time on one of these two, either the fiscal impoverishment indicators or the effectiveness indicators. So let's take a vote just to see which one is more or less familiar to people, which one people would rather see kind of a more in-depth description of. So who would rather see the fiscal impoverishment indicator? Yeah, I'll give a brief description of, oh, you want a brief description first? Yeah, sure. Okay. Good idea. So the fiscal impoverishment indicators, the kind of general issue is that analyzing the impact on poverty and inequality indicators alone, analyzing the impact of fiscal interventions on poverty and inequality can be misleading. So you can really miss important things going on. For example, the fiscal system can show an unambiguous reduction in poverty and inequality, and yet a substantial share of the poor could have been impoverished by the combined effect of taxes and transfers. So what we're trying to get with the fiscal impoverishment indicators is, for example, how many of the poor are paying more in taxes than they receive in transfers, and to what extent are they paying more in taxes than they receive in transfers, which is something that we show you miss if you only look at poverty effects of the whole system on poverty, for example, or on inequality. That's the brief description of fiscal impoverishment. The brief description of the effectiveness indicators is that we want a measure of how effective fiscal policy is at reducing inequality, for example, or poverty. And originally we had proposed a measure where you just kind of divide by spending, or you divide by spending as a ratio, as a share of GDP. But there are some problems with this original effectiveness indicator we had. So now we've defined an indicator where you're measuring what's the effect on inequality relative to the maximum effect you could have had with that same amount of spending. So I can go into detail about those indicators as well, and kind of our experience as well presenting them to policymakers. So that's a very brief description. Is that enough, do you think, to take a vote? Yeah, okay. So let's take a vote on the two. Who would rather see a more detailed description of the fiscal impoverishment indicators? Okay, and the effectiveness indicators? All right, effectiveness indicators it is. Let me show one graph from fiscal impoverishment just to give you kind of the full understanding of it before we move to the effectiveness indicators. What we're measuring here, so I'm going to have this orange line as pre-fiscal income. This is a Penn Parade, for example. We have on the x-axis the population ordered by pre-fiscal income. The y-axis is their total income. And so we're ordering them by pre-fiscal income, so that curve has to be, non-decreasing. But then some people gain income from the tax and transfer system. Some people lose income. So this blue wavy line is just a stylized representation. Some people have gained. Some people have lost. And so here you can see, what would happen if you just looked at poverty for this distribution? Well, more people have escaped poverty, which is this is the poverty line here. More people have escaped poverty. You can see that here. This is the total people who were below and now are above, then have fallen into poverty. So the poverty headcount will be lower. You can also see the poverty gap will be lower if you just add up the areas of what people have gained. That's going to be the decrease in the poverty gap versus what people have lost. That's going to be the increase in the poverty gap. You can see poverty gap would have gone down. In the paper, we show that you can have an unambiguous decrease in poverty, in inequality. You can have a progressive tax and transfer system, but you can still have people losing income to the tax and transfer system, and it can be a lot of people. So, for example, in Brazil, 35% of the post-fisc poor paid more in taxes than they received in transfers. And actually, more than half of those were still receiving Bolsa Familia, the main conditional cash transfer program. So it's not a fact of just looking at who's left out of the social, who's left out of social programs. So I'll talk later. There's a CEQ command to produce all those results. And we found them to be very useful as well in the discussions with policymakers. All right, so effectiveness indicators. An indicator that you would typically think of might be, for example, the change in inequality divided by how much you spend. The problem with this indicator, and this is more or less what we had before in the old 2013 version of the handbook. But there's a problem with this indicator. The main one is that fiscal interventions of a larger size tend to get ranked worse. And the reason for this, you could think about, okay, what's the way to transfer a program that's going to maximize the reduction in inequality or the reduction in the squared poverty gap that I get? Well, the method to do that is going to be to, give income to the poorest person up until they get to the second poorest person, then give it to the two poorest up until they get to the third, etc. That's going to be the way to transfer a given amount of money and maximize the impact you have on inequality or poverty. So the problem is that as you increase the size of your program, you're going to have less impact per dollar spent on poverty and inequality because that function is nonlinear. So that first dollar that I gave to the very poorest person had a higher impact than once I get a little bit into the program and then I'm giving $1 to a not so poor person. And so the bigger programs tended to score worse on this just because of that feature alone. So it's just harder to get as much change in inequality per dollar spent if you have a bigger program. So what there are also some additional problems with this measure. One is that it's not unit free. So here it's measuring Gini points per dollar spent. Generally, if you want like an indicator, an index, you want it to be unit free. You want it to be normalized. So, for example, it should equal 1 when the program reaches its maximum efficiency so that it's easily interpretable. Our old indicator also actually, in the denominator, we divided by spending over GDP so that it was unit free. But then that still has the issue I described before, which is the main issue. It still has this normalization issue because that could be greater than 1. It could be less than 1. It became hard to interpret. For the new measure that Ali Anami derived, and this is in one of the chapters of the handbook, the desirable properties, actually I should also mention it's in the Iran chapter, so it's a little bit, we're talking now about moving that up, at least having an authored box in one of the other chapters because it's such an important, the spending effectiveness indicators are very important. We wanted to give him full credit for all the work he did, so we had it in his chapter. And then he derives the indicators and then also presents an illustration for Iran. So it's currently chapter 16 on Iran, just kind of a heads up that it's a little bit buried. So you should go unbury it when you are interested in doing the effectiveness indicators. So we wanted to rank interventions properly. We want it to be normalized, so within a range, say 0 to 1 or negative 1 to 1, and also to equal 1 when a program reaches maximum efficiency because that enhances our interpretability of it. And we want it to have an intuitively appealing interpretation. So I'm going to do a quick aside before showing the indicator, which is how we calculate the marginal contribution of a particular transfer program, for example, to inequality, say. So let's use the example where we want to do the marginal contribution of direct taxes. And we want to measure it with respect to disposable income. You could pick any kind of ending income concept to calculate the marginal contribution. The reason we pick the ending income concepts is we want to incorporate the effects of all the other taxes and transfers because there's another chapter in the handbook, chapter 2, illustrates that you could have for example, a transfer that if you just add it to market income alone, it looks like it's progressive, but then if you actually consider everything else that's going on in the system, it's actually unequalizing in the sense that if you look at disposable income with that intervention or disposable income without that intervention, inequality is higher when you include the intervention. So that's kind of this, what we call the Lambert conundrum, because Peter Lambert had given an example of this in his book, and they talk about it a lot in chapter 2 of the handbook, which is by Ali Anami, Nora Lustig, and Rodrigo Aranda. That's just background to say, why are we doing it with respect to disposable income or consumable income or final income? Why do we want to use an ending income concept? So to get this marginal contribution, we have two important income concepts. We have the before income concept, which is disposable income without, i.e. before subtracting out direct taxes. So that's just going to be disposable income. And then we could add back, since disposable income is already net of direct taxes, just add back indirect taxes. That gets us back to disposable income before subtracting out direct taxes. Or you could think about it's also market income plus direct transfers, because that's before we've subtracted out direct taxes. But the second interpretation is more useful because often we're talking about one single program. So if we want to talk about the marginal contribution of Bolsa Familia in Brazil, then we take disposable income. In that case, we would subtract out Bolsa Familia to get income before we've added in Bolsa Familia. That would be our before income concept, and our after income concept would be disposable income. And then we just compare the Ginies of the two. So the Gini of the before income concept to the Gini of the after income concept, the difference between those two is the marginal contribution of the fiscal intervention we care about with respect to the end income concept that we're looking at. And then the intervention is equalizing if that marginal contribution is greater than 0. So Ali derived 3 classes of effectiveness indicators. We have 2 that we're calling general indicators, which are the impact effectiveness and spending effectiveness indicator. And then we have one that's poverty specific that's based on the fiscal impoverishment measures and then converting those into an effectiveness indicator. So for impact effectiveness, the question we want to ask here is, what impact is a particular fiscal intervention does a fiscal intervention have relative to its potential? So given the amount that you're spending, how much impact on inequality are you having relative to the maximum possible impact you could have? So this the numerator of this equation for impact effectiveness, let me just go over the kind of notation again. The subscript here is going to be whichever program we're looking at. So that could be a tax or a benefit or a combination. The superscript is with respect to what ending income concept are we looking at. It could be disposable income, consumable income, final income. And then the numerator of the effectiveness indicator is going to be the observed marginal contribution. So what was the actual reduction in Gini that the actual impact this fiscal intervention had on the Gini? And then in the denominator, it's going to be what was the potential impact of this fiscal intervention on the Gini. The potential impact is going to be measured as follows. We're going to say, okay, what's the maximum impact you could have with that amount of spending on the Gini coefficient? Or what's the maximum impact you could have with a tax on the Gini coefficient? So given the tax size T, to achieve that maximum, you're going to tax the richest until their income hits that of the second richest, then tax both until it gets to the third, etc. And the same for a benefit B. You're going to give it to the poorest until that equals the second poorest, give to both until they become the third poorest, etc. So that's how you achieve the maximum possible impact. So dividing the observed impact divided by the maximum, that's going to give us the measure of effectiveness.
So just a question on that. Mm-hmm. Don't you have a problem if you're using the Gini and that the Gini is more sensitive to changes in the middle of the distribution rather than at the tail? So if you're looking to optimize it, you're not necessarily going to go to the ends. I mean, I think from a social welfare function, you may well do that. And so as long as you're constant across the programs and how you treat it, but it's not actually probably the optimal way to change the Gini, just because the Gini is not a great measure.
Yes, so I'm going to have to check with Ali on that because I haven't worked through the math myself. I do know that that's a feature of the Gini coefficient is more sensitive to inequality in the middle than on the end. But is it true then that if you were to, so suppose I'm going to tax $1, is it true that if I tax $1 to someone towards the middle of the distribution, it has more of an impact on the Gini than taxing $1 to the richest person?
We need to check. I just know this is a feature of the Gini.
Yeah. Right, I'm in the same boat. I knew that was a feature, but I just trusted that Ali's argument was correct, and I haven't done the math on it, so I'll definitely bring that up to him to make sure. Right, so if it's a social welfare function where we're, all we need is concave utility, and then we would get that this is the most welfare improving, but it should also, we're kind of pitching it as the maximum effect on the Gini, because we also realize that when presenting to policymakers, we don't want to call this kind of the optimal redistribution. Then we get some pushback in terms of, I would never be able to redistribute that anyway. So now we're saying, okay, we're just measuring what you actually do relative to what you could do. So we're definitely going to have to check the math on that because that would be an important point.
And
yeah.
And the last set of bullets, is it to reduce poverty?
Yeah, so for poverty, you have an issue. So this was also for inequality. So we have the same mathematical question, which is that does giving $1 to the poorest person have a higher impact on the Gini coefficient than giving $1 to someone more in the middle?
So it's clear for the head count that it actually goes the other way. You take the person nearest the poverty line and give them a little bit, and then you'll have the most effect, but it might not necessarily be your policymaker's objective.
Yeah, so for the head count, we had realized that and made the caveat that, this method of redistribution, say, is the most reducing of the squared poverty gap, but not the head count. But it still seems reasonable, so we're going to use it even when we calculate the effectiveness indicator for the head count, we're going to use this method of redistribution rather than the kind of unreasonable one of saying, okay, how do we minimize the poverty head count? Well, we'll just give the income to the people closest to the poverty line. But we definitely, need to check the math on for example, the Gini to see whether this feature of it being more sensitive to income in the middle, whether that actually means that what we think is the kind of inequality reducing, inequality minimizing redistribution is not correct. Yeah.
Can you repeat what this means for the poverty? Because if what really ideally you'd want to do is, or at least the biggest impact would be if you give to the person nearest to the poverty line, you may end up being able to spend a lot less and make a bigger difference in terms of the poverty head count.
Yeah, right. So I have to check maybe I can check what we have in the master workbook. We may have decided that because of that, it only made sense for poverty to calculate this for the measures for which it makes sense, which would be the poverty gap and the squared poverty gap, and to not calculate it for the poverty head count.
So ratio. You don't have an effectiveness indicator for poverty, do you?
For poverty, but not for the poverty head count ratio, I think. So for the squared poverty gap.
For squared poverty, you have it, but not for FGT1.
For FGT1?
Or FGT0, sorry.
Yeah, for FGT0, I believe that so I know we had this discussion what Matt pointed out, that you give it to the person right below the poverty line. That is the poverty minimizing thing to do, but it seems kind of like not what we think policymakers should be doing. So we had that discussion. I believe the final, I could pull it up right now and check. Oh, I don't know where that file is on here, but I believe the final conclusion was that it didn't make sense to have this indicator for the poverty head count because now the interpretation is gone. It's no longer relative to what you could be doing. The normalization is gone because now you could do higher than the government maybe actually is just giving to all the people right below the poverty line. Could be higher than 1. So I'll check once we get to the second session today when we actually look at the workbook. But I believe we stopped producing those for the head count because it didn't make theoretical sense to do so. And I think then for the FGT1, for the poverty gap, it doesn't matter who you give it to. So I think we did leave the results for that because it didn't have this kind of blatant issue, even though it's not necessarily the case that giving to the poorest reduces by more than the next poorest, for example. Then for poverty indices, we also have the issue that for taxes, those can only increase poverty, not decrease poverty, but we still wanted kind of an effectiveness indicator because you could think about the government's taxing people, and there's some potential for how much harm could the government be doing by taxing, and this kind of connects to the fiscal impoverishment measure as well. How much harm could the government be doing, and how much harm is the government actually doing? So then we said, okay, well, we could define an effectiveness indicator for taxes specifically for poverty that measures exactly that. How much harm is the government actually doing relative to how much they could be doing? So to measure how much harm the government could be doing, we again took, okay, what's the way that maximizes the harm that the government could be doing, which would be to first tax the poorest person until their income 0, then the next poorest until their income 0, etc. And so that's how we calculate the denominator here. And then the numerator is the actual observed impact on poverty. So because poverty is increasing in both of those cases, both the numerator and denominator will have a negative marginal contribution, which means poverty increased. And then we still wanted the feature that higher numbers are better. So we added this negative sign to the front of that indicator so that now it's going to go from -1, which means that you're the government is doing very poorly, they're basically taxing in the most harmful way, to 0 if the government doesn't increase poverty through taxes at all by not taxing any poor individuals. Okay. So just to recap the impact effectiveness indicator, it's always going to be between -1 and 1. The higher the value, the better. And the interpretation is, given the amount we spent or taxed, we achieved X% of the inequality or poverty reduction that was possible. So that's the relative realized inequality or poverty reduction of a tax, a transfer, or a combination of taxes and transfers. So as a simple example, if the impact effectiveness indicator is 0.7, the transfers realize 70% of its potential to reduce inequality. And in the context of poverty and only for taxes, we're asking how much of the tax's potential to harm the poor was realized, with more negative being more potential for harm realized. So here's an example of these indicators for Iran, and I'm just going to focus on one point, which is that comparing the two kind of main direct transfer programs, targeted subsidies and social assistance, the marginal contribution of the targeted subsidy program is about 11 times bigger than that of social assistance, but the program is also much bigger. So then the question becomes, well, what's the difference in their effectiveness at reducing inequality? And now you can see, oh, social assistance is actually slightly more effective than the targeted subsidy program. Any other questions about the impact effectiveness indicator?
But it's still a little normative. So take the poverty indicator. You could take a program that took a lot of people just above the line and put them just below the line. And then that's a high level of harm being done by this measure. Or you could take a program that takes a small number of people above the line and throws them really, really far down. That's not going to look like it's so bad because it's just a head count number. But those people have been hurt a lot more than these broader programs. Now, I'm not saying one of them is having a worse effect than another, but it's sort of a choice.
Yes. So
you'd want to sort of know something about the numbers going below, but the depth to which they're going, right? So,
right. So, yeah, I have two. That's a very good point. I have two responses to it. The first is that, again, we're not going to focus on the poverty headcount exactly for that reason. So we're still only defining it for these other measures.
Oh, so for the harm one is still ignoring.
Is still ignoring the headcount for that reason, and then also. This is another reason, another pitch for the fiscal impoverishment measures, which are measuring the distance of how far. So in this paper on fiscal impoverishment, we basically propose a bunch of axioms for a measure, and then we derive the class of measures that meet those axioms, and they essentially give you exactly the total. So the fiscal impoverishment is exactly the amount people go down, or if they start above the poverty line, it's just the amount below the poverty line by which they, not the total income they lost if they started non-poor, but the total income it would take to get them back to the poverty line. And then the fiscal gains of the poor measure is exactly the opposite, the gains up to the poverty line if they happen to escape poverty. And then in that paper, we also show that the change in the poverty gap from pre-fisc to post-fisc can be decomposed into these axiomatic measures of fiscal impoverishment and fiscal gains. Okay, so any other questions on the impact effectiveness indicators? The second indicator is kind of a sister of the first indicator, which is the spending effectiveness, which is asking kind of the opposite question. Okay, given the amount of poverty or inequality reduction that you achieved, how much less could you have spent or taxed to achieve that same level of reduction? So here we say, here the denominator is going to be the observed total size of spending or taxation, and the numerator is what you could have spent to get to that same level of inequality or poverty reduction. So assume two alternative worlds in which we spend $100 on transfers and we've reduced the Gini by 0.1. And in world A, we could have achieved that same level of inequality reduction by spending just $30. In world B, we would have had to spend $90 to achieve that same level of poverty reduction. So in world A, our spending effectiveness indicator is 0.3, in world B, our spending effectiveness indicator is 0.9. Well, in world A, we would have, in world A, we were not spending very efficiently because we could have gotten the same with only 30%. So that's why 0.3, the spending effectiveness indicator, that's worse than the 0.9 we had in world B, because in world B, we were already spending pretty close to optimally, because we still, even if we spent as optimally as possible, we would have still had to spend 90% of what we actually spent. So clearly, world B was more effective, and that's why you see the indicator in that example in world B, 0.9, is greater than the indicator in world A, 0.3, indicating that it had a higher spending effectiveness. So here's the example from Iran again, and I'm going to focus again on the direct transfers and to interpret this measure, although I should also mention that this measure is not defined if you increased inequality, for example, because then there's no way to say, okay, how much could you have spent to get the same impact? And it's worth noting in Iran, these food transfers actually increased inequality, and so that's why you see the not applicable in the table. So to compare these two programs again, let's go to the final income column. So what this is telling us is that the targeted subsidy program, in order to achieve the same, it could have achieved the same level of inequality reduction it did achieve by spending just 27% of what it spent if it were to spend that in the inequality minimizing way. The social assistance transfer could have done it by spending 41%, so the social assistance transfer is more effective, because even if they did as well as possible, they would have still had to spend 41% of what they actually spent. Is that clear? We just had kind of a email exchange about the interpretations of these, where we were presenting results and it wasn't clear why is it that a higher spending effectiveness indicator is better, because it's somewhat not the most intuitive thing until you sit down and think about it.
Hi, Sean. Often you make decisions on, there's a budget constraint, right? So do you have a measure of effectiveness that combines the spending as well as the first measure that you presented?
Yeah, so this, well, the first measure does take into account the amount spent, because what it asks is, given the amount you spent, how much did you achieve? So it's still taking into account the amount spent. So I would say that the impact effectiveness itself kind of gives you, so if a policymaker comes and says, oh, we have a budget constraint, we're trying to determine what to best spend on, the impact effectiveness indicator itself is telling you, for the amount spent, how much more could you have done? And the spending effectiveness indicator is telling you, given the amount you are achieving, could you have achieved it with less? And if so, how much less? I don't think that directly answered your question, so maybe we can, is there a rephrasing that I can answer better?
Maybe it's because often we're looking both at taxes and spending, so you can always say, well, you could tax more here and spend more there, or some combination. Mm-hmm. So am I right to say that these are sort of abstract away from the other side of the budget? So given your budget, whatever it is, 100, no matter how you collect it, this is the best you could do with this particular spending program. And on the tax side, it's more sort of, I guess, that it doesn't really think through what happens on the spending side at all either, right?
Well, you would still know which are your most effective programs. So that would tell you, for example,
Yeah, but when you're looking at the effectiveness of a tax intervention, you're not thinking about how it's going to be eventually spent. You're just thinking about that tax intervention on its own.
Yes, although you could also combine. So you can say, what's the impact effectiveness of, like, suppose we have a particular tax that we know is being spent on a particular program. You could combine those two and do, it's the wrong one. You could combine those two and do an impact effectiveness, where you say, okay, given, where you do kind of both, to calculate the denominator, you do both ends. You say, okay, the tax we're going to see what was potentially possible. For the tax we're going to do, taxing people from the top down. From the bottom, we're going to add to people's income with the transfer. We still keep the amounts T and B fixed at what we actually observe, and then we see what the impact effectiveness of that combined tax and transfer are. So you can do that. You can't on the spending effectiveness indicator, because then there's many ways you could think of how would you achieve that with different levels of taxes and transfers.
I think it's a related comment, but I think you're also abstracting. I think this is it's a theoretical exercise, right? But you're also abstracting from all kinds of administrative costs that could be different across programs in different countries, right?
Yes, that's true. So there are many things that could affect the actual, So I think the point you're making is that the denominator here is not what could actually be achieved, because maybe there's leakage that when you're trying to transfer, you can't identify who are actually the poorest people, which is all true. So this is just kind of saying, in theory, what could you do? And then this, again, is why it's useful to be able to have the cross-country comparisons, because just like the Gini goes from 0 to 1, but no one looks at a Gini of 0.3 and says, like, oh, that's 0.3 away from like what's theoretically possible, because they know that in the most any country has ever gotten to is, say, 0.25. So you could similarly look across countries here and say, okay, the theoretical maximum effectiveness is 1, but what have countries actually achieved? And I don't have those kind of numbers on the top of my head, except for this one country here we have in the table. But you could, with results from many countries, do a similar comparison.
Since the interpretation is a little tricky, at least you've demonstrated that for the spending side. Could you do the same for the tax side?
You're saying to interpret the tax side. Okay, yes. Of the spending effectiveness indicator. Yeah. Sure. So I'll start with the impact effectiveness. So what this is telling us is that so with taxes, similarly, taxes reduce, so these are the results for inequality. Taxes reduce inequality. So for example, for the income tax, let's look at the final income column where it's 0.4. So that's telling us that the income tax, its reduction in inequality was 40% of the reduction of inequality that could have been achieved with the same amount taxed. And that's calculated if we're saying, okay, let's tax from the richest, then get them to the next, etc. For the spending effectiveness indicator, it's telling us that we could have, so you could think of taxes also, if my goal with a tax is to reduce inequality, you could also think, well, the taxes also creates distortions. So I'd like to reach the same amount of inequality reduction with as little tax as possible. Maybe that's not the objective because you need the tax revenues for other things. But suppose that's the objective, then what this is telling you is that the income tax, you could have achieved the same reduction in inequality by only taxing 39% of the total amount you actually taxed.
Just to make sure I understood this, so if you look at the semi-cash transfer program, it looks like in the previous slide it was not very effective, right? It has a negative. So if I was a planner trying to consolidate my spending programs, I would say maybe this is not working for inequality purposes, maybe for food. So you kind of use these indices to make those judgment calls. Am I right? So you look at the spending effectiveness as well as the impact, and then you say if you want to reduce the number of programs from 20 to 5, you would use some of these to make that judgment call. Is that how you would use it?
Yeah, exactly. And that's actually why we had to kind of switch to these new effectiveness indicators, because policymakers wanted to use these to say, okay, suppose I have some budget that I want to add into a program that I already have, and I need to decide what program is that budget going to have the most impact on. The old effectiveness indicators, because they had this feature where larger programs were penalized, that wouldn't give you the right ranking between programs of like what program should I actually spend this on to have the largest impact. And so these new effectiveness indicators, that was the first property that when Ali went to derive the new indicators, that was the first property we had in mind, was you need to get the proper ranking between programs to tell you which program you'll have the largest impact on if you spend that additional budget on that program. So that's the first use, is you can kind of rank programs and see which are the most effective. Going directly to the example of the food transfers, you can use these indicators to see, okay, it's not very, let's suppose those were positive. So it was positive 0.02. Then you would see exactly, okay, those are not very effective relative to what you could be achieving with that same amount spent. The fact that they're negative, you would actually see in other results too. The negative sign just means that the marginal contribution was negative, which means that they were inequality increasing, which you would have already seen in some of the other CEQ results. Is that a little more clear now, those two indicators. Any more questions on them?
So, Sean, just before we move on, my advice to people would be not to rely on a single particular indicator to evaluate any of these. This reminds me a lot of the targeting effectiveness indicators that we use in other parts of it, which we spend a lot of time trying to work out to modify because different targeting indicators can have different results due to different size of programs. So, for example, perfect targeting under a large program versus a small program can have different results by some of the measures, but it also might not take into account if you've got a very large program, let's say your poverty rate is 15% and you've got a 30% program, necessarily half of that program, even under perfect targeting, is not going to be below the poverty line. So sometimes the objectives of programs don't match up to the different measures. And so what we end up doing in the targeting is you look at lots of the different measures and you say, when you think about it in these terms, this is a better program. But when you think about it in these terms, this is a better program. And so I think in this case, one of the things you can do is the impact effectiveness and the spending effectiveness are probably quite good to use together, because I suspect you can actually probably mechanically score better, because when these are all based on, say, the poverty squared, so you're weighting necessarily a preference to the people at the bottom, and so and the poverty line's arbitrarily drawn across it, and so some programs may be bigger than the number of people below the poverty line. And so, therefore, what their impact can be, the perfect potential impact, is going to be different across programs because of that distribution and the shape of it. But then the spending one, I think, and I haven't done enough thinking on it, may invert that a little bit to, if you have greater potential on the impact side, you may be hurt a little bit. You may look worse. You may be penalized mechanically on the spending side as to what's the best way you can achieve. So if a program is better on both impact and spending effectiveness, you can probably have more confidence to conclude it's a better program from fiscal purposes in terms of impact on inequality. But I suspect you may could easily get it where it can flip. One program looks better on impact, but it doesn't look as good on spending. And it might not actually be about the design of the programs so much as what's perfectly possible depends on the shape of that distribution, how big the programs are, where the line cuts across.
Yeah, those are all very good points. I haven't worked through the math precisely either to see whether we can have these reversals, but yes, one of the reasons we produce so many results in the CEQ assessment is exactly because we should never rely on any one particular indicator and instead kind of take them as a cohesive whole that we then use to guide the discussion with policymakers. All right, I'll quickly do the fiscal impoverishment and gains measures, and then we can take our coffee break. The other 3 points were very of the outline of what's new are very brief because they're all ongoing work. So then I'll just recap those once we come back from the coffee break before we get into the Stata session. So for effectiveness, I didn't go over in much detail our FGP and FI indicators, but the idea here is again that we want to see how much. So for example, for fiscal impoverishment, how much fiscal impoverishment, this is again in the framework of potential to do harm, how much fiscal impoverishment is a program achieving, or achieving is not the right word, but how much do we observe relative to what was possible, the total potential harm that could have been done, and then on the fiscal gain side, what was the total gains relative to the potential fiscal gains to the poor that could have been achieved. So one thing to note here is if we give because this is measuring like absolute distances, absolute changes in the poverty gap, the fiscal gains measure, assuming that we don't have enough to lift everyone out of poverty, the total amount that we could have accomplished in fiscal gains is exactly the amount we spend, B. So that's the maximum, which is why here we're dividing. This is again dividing by what was the maximum possible. And same for fiscal impoverishment. The most, assuming that we're not taxing more than basically the poverty line times the number of poor people, the most fiscal impoverishment we could achieve is T, because we could collect all of our taxes just by taxing the poor and pushing them all down to zero, or pushing them all down lower. So that's again dividing by the maximum. So then basically each of these, and because that's a bad thing, we do 1 minus that. So both of these two measures are then going to have the feature that 0 means that we're doing poorly. We're either accomplishing no fiscal gains or we're accomplishing maximum fiscal impoverishment. So it's 1 minus 1. And then, or they're equal 1 if we're doing as well as possible, either accomplishing maximum fiscal gains or no fiscal impoverishment. And then this is just a weighted average of the two. So that gives us the what we call the fiscal impoverishment and gains effectiveness indicator. And once you take the weighted average of the two, it's still an index that goes from 0 to 1 that just tells you how well you're doing relative to what's possible in terms of fiscal gains and fiscal impoverishment. Any questions about this one? I know I went through it quickly.
So when you in a particular case study, when you compare the three indicators, the impact, the spending, and this one, can you show an example, or can you talk about an example where they all sort of go in the same direction and give you? Do you expect to give you similar rankings of the programs, et cetera?
Yes, and all right. So a good example for people who are more interested in this is to read Ali's chapter on it, which is in the handbook. It has an example of all the results for Iran. So I had the tables in here for the impact effectiveness and the spending effectiveness. I didn't put the fiscal impoverishment one, but I think it gives the same story. I have to double check, but one of the things in the case of Iran that came out of this was that the social assistance program was more effective than the targeted subsidy program, which is something you wouldn't have known from a lot of the other results. One reason being that the targeted subsidy program is much larger. So you get the same story here. Social assistance program was more effective with the impact effectiveness indicator because we achieved a higher percentage of what was possible in inequality reduction. We achieved a higher percentage we would have had to spend. We're more spending effective in the sense that we would have had to spend a higher percent even if we were spending optimally to achieve the same level of inequality reduction. And then I should have put the fiscal impoverishment and gains results here too, but I believe they tell the same story. I'll have to double check to make sure. And if you kind of want to see like the full sets of results, including poverty results for spending effectiveness and impact effectiveness, those are all in Ali's paper. But in theory, and going back to Matt's point, something that we should work out mathematically is so I know, for example, the fiscal impoverishment and gains one could go could tell an opposite story because it's measuring something fundamentally different. What would be interesting to look at mathematically is whether the impact effectiveness indicator, can that tell you a different story than the spending effectiveness indicator? I think that's important for us to figure out. Any other questions? Okay, well, let's take the coffee break then, and then we can jump into the CEQ data package. No, I'm just going to kind of show it. It's not as involved as last time.
No, because mine is with the fair service. I pick it up.
Yeah, no. Is there
Recommendations on the person?
Yeah, so I would say in general, we still go towards, we still prefer to present the results for the preferred income. But we have had a number of countries in that country context.
No, because we're actually quite
We've had that very clear that in a particular
yeah, and especially this kind of like could be this range of the scale. Yeah. So the thing is like that just come a little bit in the whole system. So the choice is really drives to two different directions. Either it's
I agree that
more like 0.5 points. Yeah, it's a different world. So it's not like the mind is just whether you should take reporting else and maybe not the next one. Oh, different.
then the country to so you're starting off with a point.
Sorry, I'm not American.
Yeah,
The
yeah.
case,
So
the
that's
benefits,
the
yeah.
original.
I'm gonna quickly. I have to upload a new file to make sure I have the right version of the data.
Yeah, we definitely want to teach you. I'll have CO. Yeah, I'll have CO bring it.
Like, you don't have you really want to go higher. If you just go from start.
What I would do is just run this.
And so definitely on the Genie, it's
Yeah.
true. I'm just remembering because in Indonesia, the Genie dropped recently, and we went and went to understand why. And so if we looked at the percentage consumption shares for the top 20, the middle 40, and the bottom 40, and the middle 40 gained, and the top 20 went down, but the bottom 40 also went down a little bit. So inequality was down because the middle caught up at the expense of the top, but the poor not only got left behind but fell a little bit further behind, and yet the Genie went down because that middle of the income distribution was moving.
Right.
Now, I'm not so. It's a problem in that the way I think you're doing it at the moment is you're doing what maybe the social welfare function should be, which is topping up from the bottom.
Right.
But it's actually probably possible then you can get programs that have more effect than that theoretical maximum. So you can have programs that can exceed 1 if they're moving the middle.
Right. But so, if suppose we were to like redistribute $1, you're saying it would have a higher impact in the middle than.
I think that's the case. If I took money from someone in decile 6 and gave it to someone in decile 4, I think it has a bigger Gini impact than 10 to 1.
Okay. Yeah, we'll have to check on that.
Yeah, I mean it's a problem of the Gini and how it works.
Right.
But
Yeah. So I knew it was.
might be you might. So again, you'll have problems because I was thinking, you could move to say income share of the bottom 20 or something like that as a top 10 to bottom 20 ratio or something like that. But then you get into a problem of different size programs have a different maximum potential. So if you're taking 20% share, then a very small program, if well targeted, all goes to them. But if you've got a program that covers 40% of the population, only half of it can go to that bottom 20 by definition. So this is sort of what I then went, this is the targeting problem over again.
Yeah.
You're basically not going to get...
Right. Because if we did those ratios, we'd also be cut off at it. Like the same problem you were saying for the...
and you're adding in a poverty line, an arbitrary, which I see, and also in the fiscal impoverishment becomes an issue because you don't count the bits. The people who climb out, it doesn't matter how far out they climb.
Yeah.
And the people who come down, it doesn't matter how far they started.
Right.
And so two different programs will get the same score for you. So two different, and then of course the starting distribution matters. So the biggest thing is if you compare these across countries, someone who starts with the people at the bottom being miles below the line have a much higher maximum potential to go than someone where there's not much of a poverty gap to begin with.
Yeah, which is partly why for the effectiveness indicators, why we wanted like the maximum possible in the bottom, because that takes into account the country's actual. So both the numerator and the denominator include.
No, but when you correct for that, you introduce because this is reminding me of all of the targeting stuff that I was trying to do. Because once you scale for that, you transfer the problem to somewhere else, which could be say one of size. So, what I'd say is do a couple of examples of extremes where it's perfectly targeted and equally targeted, and big programs and small programs and different distributions. Just run some simulations, and I suspect what you'll find is you can't get a perfect measure here, and really what you want to get is a couple of different measures that, I don't know. Like I never solved the targeting problem. I ended up just presenting 2 or 3 different measures, and I suspect you might be in the same boat here.
Yeah, right. Yeah, that's a good point.
Because if you think, so let's take the spending effectiveness thing. If you've got a country which has a low poverty rate and a small poverty gap, then anything spent above, say, $100 is wasted because you've already brought everyone to the line.
Right.
But if you've got a big program, it's still welfare enhancing. And if a country had a really low, artificially low poverty line, then you may have ambitions to cover the vulnerable, which is a much higher level, and this program achieves it. But it looks really inefficient because you spent a shitload of money that you just didn't need because you've already taken the bottom to the thing.
Right.
Whereas you could have a country with a high poverty rate, a big gap, then you've got lots of room to spend because all of that money will count, and the more that it's weighted towards the bottom, it's heavier weighted, but you never actually reach your maximum spending budget.
Yeah. So that's kind of like there's like a truncation in the measure.
There's a truncation in the measure, but the problem is because that poverty line varies around different countries, and then as you compare across countries, you're not comparing. Like maybe if you use you guys use national poverty lines or use $1.25s. I can't remember.
We use the $1.25s as kind of the main ones, and then we use
for comparison purposes. So that line at least is the same, but depending on how big that headcount rate is, then you're going to reach. You've got this truncation problem on what's every dollar spent after having reduced everyone lifted everyone to the poverty line is wasted. Right. So big programs which are still welfare enhancing and may have an objective beyond just bringing everyone to the line get penalised on the spending effectiveness. Right. Because they're wasting money above the line, but are they really?
Yeah. Or if because I could argue that, well, if it's a poverty spending effectiveness, then any money they're spending beyond what they need to reduce poverty maybe is wasted. But you could come in with another argument, you can't perfectly target, so then really you have to spend twice as much to actually even get to the point. And it'd also be considered wasteful.
I'd have to think through it some more, but I'm pretty sure I could come up with some examples for different size programs, for different distributions, which would say this, even these guys perfectly do it, they will have a lower indicator. Yeah. The perfect under the 2, it comes out in different ways. I mean, I think you need to do something. It's just, and there will be limitations too. I don't think you're going to get to something where you can't get a counterexample that says, well, it's a problem in this case. I think you're always going to have that. But definitely, on the spending effectiveness, you run into this problem of the max
for the poverty.
There's basically a poverty budget, and above that, you're just enhancing welfare but not reducing poverty.
Yeah, right, definitely.
And then when you compare across countries, because for the same poverty line but with different gaps, that budget's different. Yeah. So even if you had the same head count, if you have different gaps for the same line, so you'd have to market it as you're wasting money with respect to simply
bringing people to
Right. But that's a harder sell to policymakers, I think. Because if you've got a really big program that's designed to cover 40% of the population, even though you're only 10% below the line, you'd say, yeah, it's not as effective as the small program, but that's not what I've designed it to do.
Mm-hmm. Yeah, definitely. Yeah, I'm not sure what we can do about that other than, like you said, emphasize that, well, this is measuring a particular thing, which is how much are you relative to like reducing poverty given this line.
Well, it's to put some sort of a social welfare function in there, right?
Yeah.
And then to drop the line.
Right. That's essentially what the inequality ones are doing. Each inequality measure is related to some social welfare.
Yeah, I guess that's right. And so then the question is the Gini the right one there? Maybe not. So maybe
I thought that it was still, the Gini was still consistent with like a social welfare function that has concave.
It's like, I don't think it's consistent with rules in objective functions. I don't think so.
Yeah, we'll definitely have to look into that and see.
Yeah, no, I haven't spent a lot of time on the maths, the Gini bit, but I know from this Indonesian example that if you taxed the top 20 and gave it to the middle 40 and taxed the bottom 40, but at a lower rate than you taxed the top 20, you get a Gini reduction.
Yeah, so that's kind of a complicated example. What I want to know now is like if we give, because I also knew that it has this feature that is more sensitive to the middle.
So the other example would if you took one from the top 10 and gave it to the bottom 1, would they have less of effect than going from D6 to D4?
Yeah.
And that would be a very simple
one
to run. I don't know, but I think so. I think is the answer.
Yeah, so if that's true, then we definitely have a problem.
We just need to change inequality measures.
Yeah.
But then that gets a problem because everyone all the policymakers know the Gini and then try explaining a different social welfare function to them. Then maybe you start talking about bottom 20 or bottom 40 income shares. Mm-hmm. But again, then the coverage size of the program potentially gets you in.
Right. Yeah. At least if it's bottom, because those will kind of line up with, like the World Bank's.
So bottom 40 lines up with
all the new inequality talk that's all like about income shares for a certain percentile.
Yeah, exactly. So you could do that. And also bottom 40 is to the point where you've got to be a pretty bloody big program to be over 40. Right. So at least exactly. So you're unlikely to hit. Well, you will with target with subsidies and anything that's not targeted. Mm-hmm. So a lot of the programs will be on that, but it's at least vaguely better than a Gini measure, which may actually give you the wrong results.
Right.
Yeah, I don't know. It's a tough area.
Yeah. So with the poverty targeting ones, you guys were what indicators were you using?
So I mean, everyone uses inclusion/exclusion errors, but I can show you 20 million examples where that's just if you compare across programs of different size, automatically those things mean completely different things. Mm-hmm. And so then there's the CGH measure. So you've looked at the targeting measures?
A little bit.
So CGH, Cody-Gross and Hodnott, which is a measure between 0 and 1, where I'd have to dig them up. I can actually send you the draft of a paper I was working on. Okay. Now, the solutions I come up with you're not going to get anything out of there. That's I was in there and satisfied with, but all the examples of how these different measures fail on different counts, I think there'll be analogies very much to what you're doing here. And if you think through a little bit, you'll be able to come up with counterexamples for the things you've got. And so in the end, you might end up wanting to say have 2 impact effectiveness measures, which is, in terms of. And that's why I thought maybe the spending and the impact might dovetail, because the impact would be, you've said, relative to the maximum possible, which is somewhere where I went as well, which is of your maximum possible, perfect targeting, how much did you achieve?
Right.
But then, it's because basically it's a multi-dimensional problem. Mm-hmm. Right, you've got cut size of programs, you've got shapes of distributions and starting points, and different. But there was a mechanical bias in the measures, 2 smaller programs or 2 bigger programs, depending on which measure it was.
Right. Okay.
And you got the same threshold problem where a program that's 40% big and there's a 20% coverage basis. Necessarily, 50% of the people who get it, even if it's perfectly targeted to the top 40, are non-poor.
Right.
And so when you use this inclusion error, then a 10% program can achieve 100. And then do you normalize, but it's harder for it to target a smaller program. It's much easier for a 10% program to get someone in D2 which is still pretty good, because when you've got a small number handing out, D1 and D2 can kind of look the same. So you've got a targeting, but you've got biases both ways. And so you choose one measure, it mechanically biases the small programs, another measure mechanically biases the large programs. But I'll send you the thing.
Okay, yeah, that'd be really useful. Thanks.
We should start.
Okay.
Sorry, I just took all your break.
We may spend longer than you think on the health education stuff. There's a lot of interest in that.
Oh, okay. The problem is we don't have much concrete. You'll see when I present it. Yeah, I mean, we have the ongoing work, but basically the conclusion of it has been it's very difficult to do any other. There's a lot of drawbacks to all the other methods as well, and so we don't have what. Yeah. Can I get a glass of water? All right, let's go ahead and get started and get back to the description of the innovations in CEQ, and then we'll move from there to the CEQ data package. Any other questions that came up during the break over coffee? I know caffeine can start getting the mind turning, so maybe something came up. All right, then I'll go ahead and jump right back in. I'll talk about the work that we've been doing, that's ongoing work of alternative methods to value health and education benefits. As you all know and have probably kind of seen as you both were thinking about it internally and maybe have been presenting to others, there are many drawbacks with our current methods to value health and education benefits. The kind of overall, to give you the punchline of our ongoing work, is that there are many drawbacks to all methods to measure health and education benefits. And I think my own personal opinion on it is that our government cost of provision approach is going to continue being kind of the workhorse method, and that these other methods that we've been developing will be things that you can do alongside that. So you can see, as a sensitivity analysis, or you can see how big the differences are from these different methods. So what we do right now in CEQ is follow what we call the expenditure incidence or government cost of provision approach. These use per beneficiary input costs obtained from administrative data as the measure of average benefits. And this is as disaggregated as possible. So, for example, by type of care and by state for health benefits. Or if you have more disaggregated level spending than that, you can go basically as disaggregated as possible. The idea there is that there may be very big differences. In the more rural areas, they have lower quality care, and so and also in theory spend less on that lower quality care. So to the extent that there's a mapping between how much they spend and the quality, you'd pick that up here, getting as disaggregated as possible. So the approach essentially asks the following question, which is how much would the income of a household have to be increased if that household had to pay for the fee for the free or subsidized public service that it's receiving at the full cost of that service to the government. The issue is that, the welfare impact could be very different than the amount spent. So, for example, low-cost preventative care like oral rehydration therapy and vaccination can have a very large health impact, even though it's a very low amount spent. One alternative that we've been looking at is this behavioral outcome approach that accounts for behavioral change and then relies on outcomes, health outcomes, to measure welfare. This is ongoing work by Jeremy Borofsky. And the strategy here is to use natural experiments where public health insurance coverage was expanded to estimate the effect of different health interventions that people are now receiving that they wouldn't have received before on mortality and other health outcomes. And then for the mortality outcomes, then convert those to dollar values using a value of a statistical life measures. There's also limitations of these approaches. One is that necessary data and the types of natural experiments being used to evaluate the welfare impact are not available in most countries. And it relies on these value of a statistical life estimates. There's a whole literature on those, but there's also, and that literature points out many potential drawbacks. My main concern with the value of statistical life is that you can get very wide kind of estimate ranges, which then would have very large impacts on your results from the CEQ assessment. So, as I said before, I think that these will most likely the kind of main results that you'll be seeing from CEQ will still be using the current method, and these will be alternative ways that you can look at what the potential impact of health benefits are if you want to go beyond just what the value of what the government is spending.
So I think for us the big question around health is how to treat whether it makes sense to treat health spending as the way it's been done in the past, where if you observe in your household survey somebody attending public health provision, at whatever level, then you basically assume, okay, this person has attended, we're going to give him the value of government provision per person, right? Uh-huh. But if we don't observe the person getting a benefit or using the service, then we don't give them that benefit. Especially for low-income countries, that has been the practice. The problem with that is that you end up giving more benefits to sicker households. And if you think about it, then their final income measure, their welfare, the welfare of the sicker households will look better than the welfare of the household who happen not to be sick, which doesn't make any sense because households that weren't sick still had access. They just happened not to be sick, right? Right. So in some way, there's a issue there in terms of how you assign benefits based on use as opposed to based on access. In the high-income countries, we've been using the insurance approach, where in countries where everybody has access, it's known that whether you're sick or not, you have the option of going to get health care. In those cases, typically what is done is you just take the total health spending and you divide it by the population, because everybody has access, and whether you're sick or not, it's sort of the insurance value, right? It's the fact that you have that option. So my question here is, doesn't it make sense to come up with a measure that like the insurance approach for developing countries by assessing sort of access, using some proxy of access in the household survey or maybe from a different survey, that would be better than just assuming that if you're sick, you get the benefit. If you're not sick, you don't get the benefit. So I don't know how much thinking there's been around that.
Yeah. So in terms of the insurance value versus the use approach, we've done a lot of thinking about that distinction in particular. A lot of it also depends on there's a lot of variation of health systems in place across countries as well, which can affect which approach you take. Or we've had a number of countries that take a combination of the two, because it's both. There's both kind of an existing public health system that you could go to, and in that one, we're not really sure who has access to those facilities or who would use those facilities. And so then you use the use questions, but then they also have some sort of non-contributory health insurance system. And so in some countries that have a combination of the two, we've combined the two approaches to measure health benefits. We have tried to use the insurance value also in a number of the developing countries. And then the issue there, which you raised, is that it doesn't necessarily, having technically the insurance doesn't necessarily lead to access, especially in poorer countries where there are constraints like distance to the health facility, and things like that. So we haven't really come up with a way that would combine the insurance value with differences in access across the income distribution or differences in, you may not only want to know about access, but since our goal is to see like what's the distribution of and the incidence of the actual government spending, then it's not necessarily the case. Suppose everyone has access and can use it, but the richest 20%, because it's lower quality, are never going to use it. Well, then if we want to see how progressive it is spending, we want to incorporate that information that the richest 20%, even though they could use it, are not actually using it.
That's easy to do, right? You can just make assumptions about opting out at the top, because you can observe in the household survey who spends on private health care. So if you observe your households at the top, spending out of on private health care, then you don't include them in your benefit from the public sector. The problem is what kind of variable would you use to proxy access? And to what extent you have to go to a secondary survey in order to do that? Because I don't, at least the CEQs that I was involved with you guys, it was always, let's use if the household accessed the public service, then we assume that they received the benefit. If they didn't access, then they didn't receive the benefit, and that gave us a lot of variation. But again, I still think it was the wrong approach, because especially in low-income countries, you're assuming that the poor or those who are sick, who also probably happen to be poorer, are getting a bigger benefit than those who are not sick. And actually, if you talk to Adam Wagstaff or anybody like that, when I've discussed this with them, he's always said to me, that's just the wrong approach. It's just wrong to do it that way. You have to have some better measure of access. So I don't know, to the extent that we're able to come up with proxies for access, even if it comes from a different survey, I think that's a much better approach. And actually, that simplifies things, because in that case, if you have access, then you don't need all the level of disaggregation by type of benefit. So for example, in the case of South Africa, we had spent a lot of effort and a lot of time going to looking at, is it primary care? Is it secondary care? Is it tertiary care? Within tertiary care, is it a C-section, or is it a cardiac kind of operation that the patient is getting? Because the value of those are very different, right? Even though they're both tertiary care. And we had spent a lot of time on that. And when you think about it, well, actually, all you need is sort of, do you have access or not, then you don't really need to identify that level of detail. All you need to identify is, does the household have access to that kind of care, yes or no? And then you would give the household, all households who have access, the same value amount, because they have access, not because they actually used it. You see what I'm saying?
Yeah. Go ahead.
You will have another question. If you want to go that way, probably you need to have two types of expenditure in healthcare: investment and non-investment expenditure. Investment, you can say that, okay, investment expenditure, it comes to access. Everyone when you have a big investment, those who have access, have used that. But if I never use this service, I don't know why non-investment expenditure you have to impute this type of expenditure to my household. You have to make this type of expenditure.
But I think it is a fundamental question. Is it because you don't go because you go to private healthcare? In which case, I agree with you. You shouldn't include that household because you've opted out. That household opted out of the public service. Or is it that you don't go and get, a C-section because you never needed a C-section, but it just happens to be the characteristics of your household that you never needed it, or because you never got sick in that way, but you still have access. You could have gone and gotten radiation treatment for cancer because you happen to be sick, because otherwise what you're doing is you're giving. And it's not a little bit of money. It's a lot of money that you're imputing to a household, to those households who are sick, just because they're sick and they happen to go for cancer treatment.
It can even happen in some situation that you have poor households, not far from, a big hospital, or they don't really have access. They have physical access, but the cost of, paying this service, they don't have it.
Absolutely. That's exactly my point. What really matters is, do you have access or not? It doesn't matter the distance. It matters, can your household go and get cancer treatment at the next door hospital or not?
So I agree this is philosophically interesting, but yes, now it doesn't save you on the data issues that you were talking about, because now you've shifted all the burden to access questions. But in Indonesia we use a simple question: do you have health insurance, right? And so, but that doesn't mean that there's a hospital to provide these care in your particular area. And so now there's access to what different types of levels. So I agree it's an important question, but in a practical sense, I don't think it solves the data. It doesn't make data more any easier, because now you need a whole lot of different access types of questions, which might need to come from a secondary health questionnaire.
But I think that's maybe where we should put our emphasis, as opposed to saying, because you accessed, because the survey says you went for cancer treatment, then you get, 50,000 whatever pounds. But this other household who had the same access just didn't happen to have cancer, and so they're worse off because of it, which is what we were doing in the past. We were saying you have two identical households, they both have access. This one happened to be sick, so now that household in your survey, when you impute the value, is going to look much better off than the other household. That doesn't make sense to me.
Right. So it doesn't make sense when you look at individual households, but I would argue that we're still in the aggregate doing a good approximation of. So, for example, we're saying, okay, one person in the bottom decile went and used this cancer treatment, and so we're imputing all the benefit to them. But remember, we're not looking at poverty for final income, so we're looking at inequality, for example. It depends what indicator you want to use, or let's say the concentration coefficient of health spending. We're going to get a very similar number if we say this one household got a large benefit, or these 10 households around them got 1/10 of the benefit each. On the concentration coefficient, you're going to get the same result.
Just from the ECA countries where there is a health insurance, it's very different if you just impute the value to those that accessed versus if you impute it to everybody who has access, right?
But is that different when you're also taking into account different types of care, or when you stop taking into account?
Because what happens is when you assume access is what's important, it becomes much more neutral, because a much larger portion of the population has access relative to those who actually used, especially the most expensive kind of care.
Right, but I would argue that you're going in the wrong direction by doing that, because, so for example, let's take cancer treatment as an example again. Maybe in theory the people have access, but really among the people who have access to public health care, it's still going to be the richer people who, for whatever reason, are the ones able to access the cancer treatment, whether it's because of user fees or access to the particular facility that offers that cancer treatment, for example. And because you don't have all that information, we're doing a better job, because in expectation in the survey, we're going to still see that. We're going to see, cancer treatment use is higher among those in the higher deciles. And then when we use our method, that's going to show up when we do the concentration coefficient, for example, because there's going to be those higher benefits to the people who are getting the cancer treatments, who happen to be not by chance, but because of access issues, who are in the higher deciles. Whereas if we just say, okay, all of these people had access, and we're just going to give them all the average benefit, we lose that variation in terms of access overall. Doesn't necessarily mean access to particular treatments, and that is correlated with income. So I agree that, like, if we're looking at individuals, then from this philosophical perspective, we're doing the wrong thing by giving large benefits to particular individuals. And I think it would be really interesting to debate with people who have thought about it a lot, like Adam Wagstaff. But for the concentration coefficient in particular, for example, that measure, we're getting almost the exact same thing, if one person received a cancer treatment in expectation, that's like there could be 10 people with access to it, and we could give 1/10 of the benefit to each. But if they're all around the same income, then we're going to get a very similar number for the concentration coefficient. And I would argue that in the absence of very detailed access data, then we're actually possibly losing too much information when we go to it. But in theory, if we have the ideal access data, then this is definitely something that we would want to do, because of all the theoretical reasons that we shouldn't be giving the benefits to the particular households that were sick, and so maybe I can push. So I know like Jeremy Borowski, for example, was using data that does have distance to health facilities and things like that when he's using that as an instrument in his analysis to assess the impacts of expanded access to health services. So maybe we can actually just do something more basic with that extra data, which is to say, okay, let's use that data to now, or data from other surveys to try to get at access. And we can definitely kind of push our direction of research on the health side into that. I would just say that as we do it, we need to really keep in mind that these other aspects, that access overall doesn't necessarily mean access to all the services, and access to different services can be very correlated with income. So we would have to have very high quality data, as Matt pointed out, to be able to use those methods. Another, oh yeah, no, okay. Yeah, that's definitely a discussion we are very interested in continuing to have with people who are doing CEQ assessments within the World Bank. If anyone has particular data sets that you think are very, that illuminate these access issues, we're definitely very eager to continue kind of pushing the frontier on that, on valuing health benefits. For education, we do the same thing that we do for health, essentially. There's not these issues of using use, but there's still the issue that the welfare impact could be very different than the amount spent. So in theory, we probably want the net present value of education benefits over time. There are some other possibilities that have been proposed. One is Mincer regressions to try to get at that value, but there are a bunch of reasons that those might not actually estimate your private rate of return to education. So in ongoing work by Sergio Ursua, he's looking at estimating internal rates of return by modeling the decision of whether or not you pursue an additional kind of level of education, whether or not you go on from primary to secondary, and estimating those rates of returns. There are some drawbacks to these methods as well. So one of them is that it leads to estimates. So econometrically, you can't basically get out of this method what's the level return you get for each, what's kind of the absolute value of the return you get from each level of education. Instead, what you get is what's the difference from going from primary to secondary, what's the additional return you get from that. That's one of the drawbacks. But luckily, in education, we don't have as big of a problem with, there's not this concern that there is for health, that using use of education is so far from what we should be doing.
On this, I guess my concern is that there's a time inconsistency, because the Mincerian regressions would be on historical data or even this year's data, but that doesn't say anything about the returns to the education that's going on now. So if you are currently in secondary education, you can't really predict what the returns to that education is going to be, 5 years from now or 10 years from now. So I think there's a time inconsistency problem. As you know, the rates of, or the education premia change a lot over time, and they've been actually falling over time for many of the developing countries. So I don't know, I agree that this is ideally what you would be doing, but it does have that problem.
Yes. I guess that there's no, and that problem is something methodologically it's impossible to get around. In a counterpoint, you could maybe argue that, well, it's their expected rate of return if they don't have, like maybe my prior about what the future rate of return, I'm just going to use today's rate of return to think about what my expected rate of return is. So at least we'd be estimating their expected rates of return. But yeah, there are a lot of issues with trying to estimate rates of return, and that's an important one.
Sean, do you have examples where you also look at the quality issue? Because in India, one of the biggest issues is the quality is falling. So one of the things we would like to do is to use like test scores and things like that. So do you have examples of other countries where you have looked at quality of education spending?
I don't think so. So we, again, try to disaggregate, but that only gets at quality to the extent that it's correlated with spending. So maybe in some places, so the U.S. is a good example where there's a lot of local they raise finances for the public schools locally, and then they spend locally, so there's huge variation in spending, and that variation is closely tied to differences in quality across schools. And so when we did the analysis in the U.S., we tried to get as disaggregated as possible of spending by student, spending per student. So, but if you kind of abstract from differences in spending and just try to get directly at quality, we have not really done that. I mean, this is in some sense trying to get at quality, because quality is going to affect the rates of return to your education, but I think this is just getting averages still.
Also, you don't know if it's a change in quality or if it's just simply a change in the technology, in the labor market. There's less demand for tertiary educated people, or the demand is lower than the supply, so the returns are going to be lower. It has nothing necessarily to do with quality. You don't know how much of the change in returns is due to changes in quality.
Right. Yeah, it's very hard to pinpoint just kind of in itself the quality aspect, because even suppose we use test scores, then there's the endogeneity issues of, well, we could use differences in test scores across space, but we don't know whether that's based on differences in quality, in like the quality of the education, or whether students in certain areas would have gotten lower test scores anyway. So it's hard to.
Sean, so something that applies to both education and health is, and I've just had a quick chat with Gabriela, and I'm pretty sure we don't do this in Indonesia, is we spatially adjust income and consumption levels for households to differences in costs of living across space, but we don't do anything on the administrative side. But the costs of providing, say, education or health in a particularly difficult to access rural area are going to be very, very high, and that's going to look like a big benefit to that particular household compared to, say, someone in an easy to access urban area. But it's not going to represent, and this is just another of the problems, but it feels like this is one that we could tackle, since we do have some measures of price dispersion across areas. So in any of the other CEQ countries, do we deflate not just on the household side, but on the administrative side as well?
I am not sure. I don't think so. Yeah, and actually even deflating on the household side is not that common throughout CEQ analyses. So there's always been this trade-off between theoretically you should spatially deflate to account for differences of cost of living. There's been the trade-off between that and then having results that are, say, comparable to what the country is used to doing. The poverty numbers that the World Bank poverty groups produce, that the government is used to seeing, and in a lot of countries those don't spatially adjust. So I think in CEQ often they've just kind of followed what's been done already in the country. But I would think that if you did adjust, so the couple of countries I've worked on, we didn't do any spatial deflating. I would think that if you did on the household side, you would also want to do it for the health and education benefits, right? There's no reason that if you're doing it for everything up to disposable income, that you shouldn't also do it for the health and education benefits, I would think.
It's not clear whether you deflate just with a regular spatial CPI or, cost of provision may have a different, deflator that one should use.
Yeah,
that's I agree. So it's difficult to choose your choice of deflator. Deflator a better deflator than, say, taking CPI as a proxy for what the relative cost of provisions would be.
Yeah. No, that's something that I don't think very many countries have delved into, and we haven't delved into very deeply on the methodological side either, because you could also think about it in terms of the cost of provision. You could think about it going both ways, where the more rural, difficult to access areas are particularly expensive to provide those services, but also, since a large part of education expenses is salaries, also the kind of densely populated urban areas where salaries are high are going to be more expensive to provide those services.
I think it's also good to point out that both for education and health, I don't think there's been a standard for whether you include capital spending or not. We've kind of done it ad hoc. So, for example, in Ethiopia, we explicitly excluded capital spending because it was huge and it made, but in other cases, we've included all of education spending as part of the incidence analysis. And this matters because, of course, one of the big drawbacks of CEQ is that it's a picture in time. It doesn't give you any information about the trade-offs over time. So, for example, if you were talking to a government who spends a lot of money on cash transfers, automatically that's going to reduce the number of poor. It's going to look more redistributive. It's going to look like that system is better than one that, for example, spends the same lot of money on education, especially if it's capital expenditure, right? Which is sort of some government that's sort of looking long term to their growth and their, improving the education of the workforce. And so making those trade-offs, those decisions between consumption and investment is not possible with CEQ. It's not a good tool to sort of inform policy around those trade-offs. And so when you're talking about do you include or not include investment spending for health and education, this matters, especially if it's a lot of money, or if that amount of money is sort of changing over time. So I don't know if maybe some standardization would be relevant.
So we now, I'm almost positive, say to include it always in the handbook. Yeah, so we had this problem of it not being standardized across countries, but we didn't have a clear reason for it to kind of always be one or the other. They're just telling you two different things. So now what we say in the handbook is to include it with the caveat that we have in the handbook, which is always that if there's some aspect in a particular, that we should always be sensitive to country context. So if there's some aspect that, for example, if some country had a ton of infrastructure spending in one particular year that isn't common, that isn't kind of their usual amount of infrastructure spending, then you would want to second guess that decision. But you guys have way more education and health experts than we do, so this is something we can also.
But what about including the flow of depreciation? The flow,
Don't include the entire capital expenditure. Make an estimate on what the useful life is, and then take a single year of depreciation.
Right. So that would be. I guess the issue, but you're also depreciating then from other. So the assumption in ours is that this year's capital expenditure is similar to every other year, because you could, if you had one particular year that you knew was really abnormal, that's exactly what you would want to do. But if it's a normal year, that's not what you want to do, because then you're not counting all the capital expenditure from previous years that's now being used, right? But yeah, this is also an area where we know the World Bank has a lot of experts, and so we're very open to continuing the discussions on that and making any modifications that are necessary. Any other questions on education? All right. For underreporting and undercoverage, I'm just going to say a quick sentence because we should move on to the CEQ data package, which is that for a variety of reasons, we know there are bias in inequality estimates. It could be people underreport their incomes. Richer people are more likely to not respond to the survey. Let's focus on those two. And actually, neither of them give you a kind of distinct prediction about the direction of the bias of inequality. What we're working on currently in ongoing work is in ongoing work with Facundo Alvaredo and Mauricio de Rosa, Nora Lustig, and Andrea Vigorito, and myself, is merging an individual level survey with tax return data so that we can then go in and test actually how big is, because up until now there's been no country where they've been able to directly at the household level merge that data, so you don't actually know how big each of these problems are, and we don't know how good any of the proposed correction methods are. So the work we're undertaking now is to quantify each of the different problems and then how well the current correction methods do and whether we can recommend any better ones. Currently in CEQ, we don't recommend doing any correction, partly because we don't know how good the kind of proposed, in the literature they propose, for example, one is fitting a Pareto tail to the top end of the distribution. That relies on a lot of assumptions, and up until now, no one's had the data to test how good are those assumptions, how well do they reflect reality. All right, any other questions about any of the innovations or methodology? Because now I'm going to go into the CEQ data package. The goal on the CEQ data package is to kind of give you just assuming that people have worked with it before, give an overview and return to the treatment of the social insurance, how that maps into the CEQ data package, the treatment of pensions. Talk a little bit about the newest commands that were just finished this spring, since you may not know about them. Talk about, and then give some tips about, for example, what commands could you run first to check your basic results. I think since there are so many commands, there are 32 of them, it can be overwhelming, and it may be helpful for people who are actually doing CEQ assessments to have a little guidance about what commands might you use first when you're just initially starting to construct your income concepts. And then finally, I'll talk about the ongoing work. And I should emphasize, in the ongoing work, the CEQ data package is complete in the sense that all of the results from Section E are now have commands to produce those results. If you're using it and you have any issues, definitely contact me, because if, obviously, for example, if we find a bug, then we'll fix the bug as quickly as possible and update it. But it's complete in that sense. So now the ongoing work is just to create some standalone commands that you could use on the side if you want to produce things that don't go straight to the master workbook. You just want to get some results like any Stata command directly in Stata, which we think will be useful also for people who may not even be doing CEQ assessments but want to use some of the CEQ indicators like the effectiveness indicators and fiscal impoverishment indicators. So to get started with the command, for anyone who hasn't used it before, you just need to do update all to make sure you have the most recent updates to Stata, and then do ssc install CEQ. If you include replace at the end, it'll make sure that you replace, if there's been any updates, that you get the newest version of the files. And then I also recommend including the above lines in your do files that use the CEQ Stata commands, because that ensures that you'll always be using the most recent version of the commands. We have a number of resources to get used to the CEQ Stata package. There's a handbook. There's a chapter in the handbook that first kind of gives the detailed definitions of all the indicators used in the master workbook sections D and E. So if you are looking at any results and you say, I don't know what this number means, I don't know what this indicator is, how it's defined, all of those definitions are included in Chapter 7 of the handbook. And then the next section of Chapter 7 goes through all of the commands and the syntax of the commands. A lot of them have a very common syntax, so it kind of breaks it out into, here are the income concept options and how they work, here are the fiscal intervention options and how they work, etc. You can type help CEQ, and I'll give you a list of all the help files for all the commands and a brief description of what each command does, and then you can click on the help files for individual commands to get the more detailed descriptions. Please send me an email if you have any, if you get any error that you're not sure about, or if you have any suggestions to improve the package. We're always working on improving the package. So one example, we recently, people who have done CEQ assessments know that some of the commands are quite slow. We're estimating a lot of stuff. And I had written the code that estimates the Ginies, just typical Stata code, but Meta, which I'm not very familiar with, I only know a little bit, is much more efficient for programming these kind of computationally intense estimations. So at the World Bank, Paul Corral made a more efficient, or programmed basically the same thing in Meta, and it improved the efficiency of our commands and makes a lot of them run like 5 to 10 times faster, the ones that calculate a lot of Ginies and concentration coefficients. So hopefully everyone can benefit from that. That's just one example of ways that we're always working to improve the package. So now the version online has that improved code in it. All right, so let me return to this diagram to emphasize basically how this kind of framework for the income concepts maps to the CEQ Stata package. So so every Stata command, CEQ Stata command, has the eight options for the income concept. So that's what I've put here next to the income concepts. Like market is one, M plus pensions, net market, disposable. So in each of those options, you put the variable corresponding to that income concept. And it should already be, for example, if you're doing, household per capita values, it should already be the household per capita version of the income concept. And then we also have options for each of the fiscal interventions. Now, those aren't used by every single command. They're only used by the commands that display results where you need to know, for example, the accordion ones we were talking about earlier, where it displays disaggregated results for each income concept. Then you also have options, for example, D transfers. For your direct transfers, And what you do to get that accordion of disaggregated results is you give it each individual variable for each individual direct transfer. So within that option, you could have 6, 7, 10 different variables, however many individual direct transfer programs you have. And then the Stata will automatically also generate kind of a sum of all those, which is total direct transfers. And so, again, the thing to emphasize with treatment of contributory pensions is that you should run so you need to only run each of the commands once to produce one set of E results. And in that running it once, in the market option, you should give it this market income variable that would not have had contributions to pensions subtracted out yet, and that would not have had contributory pensions added in yet. In other words, that's the pre-fiscal income in the pensions as government transfer scenario. That's the income concept that you give to the market option. And then you would have added contributory pensions and contributions to pensions to have market income plus pensions, which is the pre-fiscal income concept in the pensions as deferred income scenario, and that's the income concept that you give to the M plus pensions option. Is that clear? So this is going to produce results where you see, for example, in the Ginies, you see 8 columns for the 8 income concepts, and then again, you just need to, depending which scenario you're trying to analyze, you need to pick, am I looking at the market income or the market income plus pensions Gini as my starting point. And then for the option, the sum of the commands that have sheets, one sheet for each possible ranking, then you would need to go to the particular sheet, whether it's market or market income plus pensions sheet, depending on which scenario. All right, so the newest commands that we have are CEQ marge, which automatically calculates the marginal contribution of each fiscal intervention to inequality, poverty, re-ranking, and a variety of other things. And so before, we had the Ginies, we have this sheet that produces like Ginies for extended income concepts, which we consider if you take any of those 8 core income concepts and then subtract out or add in one particular tax or transfer, that gives you what we call the extended income concepts. So up until we had this command ready, if you wanted to know what was the marginal contribution of Bolsa Familia to inequality, say with respect to disposable income, you would have had to compare the disposable income without Bolsa Familia Gini from those extended income concept results to the disposable income Gini and kind of manually take the difference between the two. And now CEQ marge automatically calculates all those marginal contributions for you. CEQF calculates effectiveness indicators for the broad categories, going from one core income concept to the other. So you could compare, for example, the effectiveness from market income plus pensions to gross income. That tells you the effectiveness of total direct transfers. If you want the effectiveness of a particular program or tax, then you would use CEQF Ext. The Ext is for the extended income concepts. And then we also have a lot of results on coverage. So, for example, what are the rates of inclusion, the errors of exclusion of different transfer programs? Those are all in the CEQ coverage sheet command. And finally, we have CEQ target, which is the same but among a target population. So let me show you the. There are some extra options in CEQ target that allow you to define the target population. So if I can't get internet here, I already have the commands here. So I'll just show you the help file for that So the help file for CEQ target, this will kind of give you an example of what the help files look like, and also what additional options are in CEQ target that allow us to identify both. For the coverage among target beneficiaries, we need to know both who's receiving the benefits of a program as well as who is a target beneficiary for the program. And so this might depend, for example, we might say for a conditional cash transfer program, we take the program rules, all households with kids in the appropriate ages, for example, and with income below a certain amount or with proxy means test below a certain amount are eligible for the program. So the CEQ target command has your typical income concept options that every command has. Then it has your fiscal intervention options, where you describe each direct transfer, for example, each direct tax in those options. And then here are the options that are specific to this particular command. So we have these direct beneficiary markers where you have a dummy variable that tells you whether someone received benefits from the program. And the reason that you might think, okay, well, I already told you the direct transfer variables. You should just be able to use those and tell me who's benefiting. Why do I have to specify an extra option to say who's benefiting? And that's because in the coverage sheets, we distinguish a few different types of beneficiary measures. One is direct beneficiaries, who's like the person in the household who's actually receiving the benefits from the program. So if it's targeted at mothers and the mother is the one who receives the benefits, then she's the direct beneficiary. And then we also have the overall household, and then we also have total direct and indirect beneficiaries, which is everyone living in the household with the direct beneficiary. And so because for example, the fiscal interventions variables, those should all already be in household per capita terms for all the other estimations. So we need this separate direct beneficiary marker where you mark who in the household received benefits to be able to calculate the ones that the kind of direct beneficiary coverage markers. And then we also have a set of options. So those previous options to mark the direct beneficiaries, those are for both the CEQ coverage and the CEQ target commands. Then for CEQ target, we also have these target beneficiary markers where you mark the target population of the program. So often that goes by the program rules. So the stated kind of beneficiary population in Chapter 7, we have a table that specifies, for different types of programs, how could you determine who the target population is? If there's a stated target population, like would be the case for a bunch of the direct transfer programs, then we use, according to the stated target population, the eligibility criteria. That's how we define the target beneficiaries. So then what the command does is it takes all that information and then it'll calculate, for example, what % of the target beneficiaries within each income group are actually receiving benefits, and a number of other coverage and leakage indicators. Any questions on CEQ target? Okay, so the ones that I'm actually going to kind of spend time walking you through a little demo are not these newest ones, which are a bit more on the complex side of the spectrum, but instead I wanted to demo with you the ones that are a little more, that are the ones you would use when you're kind of first starting a CEQ analysis. I figured we could walk through a little demo of how those work and what the results look like to give you an idea of how you could incorporate them kind of early on in the CEQ assessment process. So the first command to mention among the commands to run first and check basic results is CEQ PPP. So that one's used as an input to other commands. It just automates the PPP conversions for you. It actually uses, it's just a wrapper command on top of WB Open Data by João Pedro Azevedo. But what this one will do, so if you were to use his command manually, you'd have to go and say, I need this country this year, et cetera, and then do the kind of PPP conversion yourself. What the CEQ PPP command will do is you just tell it the country, the survey year, and the year of PPP conversions, meaning like are we using the 2011 numbers or the 2005 numbers or the 1993 numbers. Once you tell it those three things, it'll get the appropriate numbers for you, and then it will save them as local macros, and then you can just feed those local macros directly into all of the other CEQ commands that will do the PPP conversions automatically for you. So I'll walk you through how that would actually work for a command. So that's kind of the only command that sits apart from the rest in the sense that it's one that you would run. It doesn't directly produce results in the workbook. It's one that you would run as kind of an input to the other commands. CEQ Assump gives inequality, poverty, and distribution results by decile. And unlike the other commands, there's no specific options for each income concept. So rather than have those 8 income concept options, what this one will do is it says, okay, give me as many income variables as you want as a var list, the way you would normally for any command right after CEQ you would put a var list of the variables that you want to produce results for. And this can be useful because it can give you a first glance at results. So I could give it the kind of typical core income concepts if I wanted to, or a subset of them. But I could also test the effect of different assumptions when I'm constructing income concepts. So I could say, oh, what I want to do is I want to see what the impact of my measure of imputed rent is. So what happens if I include versus exclude imputed rent from the market income concept? Then I could compare quickly, what does the kind of distribution look like? What do our summary indicators look like with and without imputed rent? And then it's also useful for policy simulations. So Steve Younger has used it a lot for this, where the policymakers are interested in some sort of policy simulation. You program that simulation, and then you can directly look, very quickly, what would the effects of this simulation be? So you can compare, what's actual disposable income versus disposable income when I did some simulation. I changed some aspect of the tax system and the transfer system. So it can be useful for that as well. So let me go ahead and walk through a little demo of what CEQ Assump would look like. Let's go here. All right, so I'm going to use a sample data set from Brazil. It's just a 1% sample that I have here, so I just need to switch to the right folder. All right, so let's first look at the help file for CEQ Assump. And it went back to small text. So CEQ Assump command, as you can see, rather than this one doesn't have the typical income concept options. Instead, it takes a var list here. And then, as usual, we can specify an if condition or in to get only observations in a certain range in our data set, specify the weight. And then there's still a sheet of the master workbook where you can print the results. And the reason we did it that way was we also want to see, of the important different assumptions teams are testing. We also wanted it to be part of the results that then get reviewed as part of the quality control process. So these print to sheet E28 at the very end of the workbook. And then optionally, you could still give it these PPP conversion options. And the reason is that we want to be able to produce, for example, summary poverty results for the different poverty lines. And so it also takes these poverty line options. And let's go ahead and just jump into producing those results. So I'm going to use my Brazil data set. Let me make this bigger as well. How do I do that? This is too small for anyone to see, right? Can we see this? All right, so I'm going to use the Brazil data set. I'm not going to use best coding practices right now since we don't have time. So let's just get the basics in here. All right, so then we'll just describe and see what the data set looks like. Where's my font size? Okay, so let's see where the font size is here. All right, well, I'll just tell you there are the income concept variables in this data set. There are different fiscal interventions. So, for example, there's one for Bolsa Familia here, scholarships. These are all the different direct transfers. And then in this data set, I also have one where I was just looking at, what's the value of market income if I exclude imputed rent? So that was the example I gave you earlier. We want to see what's the impact of our imputed rent measure on kind of our resulting inequality results. So let's just go ahead and use CEQ Assump to compare the market income measure that includes imputed rent versus the one that excludes imputed rent. And here I already turned these both into household per capita values. So the same as when I'm using the income concept options in the other commands, I want to convert everything to household per capita, or if you're using an equivalent scale, household per adult equivalent. So all I need to do here then is list in a var list, after the command name, those two income concepts I want to compare. So here we have a market income concept, which in the data set is called YMBC, back when we used the benchmark case terminology. And then we have this market income with no imputed rent. Then I need to specify the survey weight. So in my data set, that variable is just called W. All right, and now let's give it some options. So going back to the help file, we have these PPP conversion options. First, I'm just going to run it without those options to do it more quickly. And what that's going to do is it's not going to produce the poverty results because I didn't, because you need to do the PPP conversions to compare, for example, to the 125 poverty lines. I do need to always tell in all the CEQ commands so that the commands can be flexible, whether you have a data set that's already at the household level, where each observation is a household, or at the individual level, where each observation is an individual. You always have to specify either the H size, which if it's at the household level tells it how many members are in each household, or the household ID, which tells it if it's at the individual level, what's the common household ID across each member. So in this data set, that's called code UC. And then let's see what other options I need. I don't think I need any other options. I'm going to go ahead and use the open option because that's going to open the master workbook automatically. I do need to specify the master workbook, so that's the last thing we need to do here. So you always specify after using what the Excel file that you want to print results to is. So I have that Excel file here. In this folder, and so what I'm going to do is I always keep one set of like the blank master workbooks, and then within the do file I'm going to copy the blank one to another file, and that's going to be the file that every time I run the do file it kind of pulls that blank one, starts over, copies wherever I'm going to be saving the results, and then saves them there. You want to always copy directly in your do file because, for example, suppose you had produced results once and then you produced results again onto that same file, but you didn't first copy the blank one. Well, then if there's some other extra column in the old results that doesn't belong in the new results because you specified one less variable or something, it's not going to overwrite. There's no way to get it to overwrite extra stuff without overwriting all of our pre-existing formatting in the Excel. So you always want to kind of copy the blank one first. So I'm just going to copy from the appropriate folder. Let's see. So it's in MWB 2017. And then it's going to be sheet E28 is the one for. So at one time we had all of the. At one time we had all of the sheets together. We had kind of one big sheet E Excel, but that was way too monstrous. So now we've separated for each of the E sheets. All right, so I'm going to copy that file, and then I'm going to replace it here in my Stata folder, so that's fine. Let's just call it E28 Brazil. And then I'm going to say replace so that if I rerun this file again, it'll replace the existing blank version. And then I just have to put that file here that I'm using is this E28 Brazil file. And see if it works. Or if I forgot about an option. So it's not finding the file. May have specified the path. Oh, see what I did? All right, so going to the results window. All right, so I ran the file, and now it's opening the. So you see when you run it, you get these messages here in Stata. It'll tell you, oh, it's running version some version of the command, gives you a timestamp, and if you do send me an email because you had some issue, please include that version number in the email, because that's how I make sure that you are using the most recent version, for example. And then we've programmed it to produce some warnings if anything looks fishy here. The only warning is, well, you didn't specify the PPP options, so we're not going to produce poverty results, so that you don't open it up and become surprised at why there are no poverty results. You'll know why. And then here we can look at the results that came out. So as I said, I didn't produce any poverty results, so we don't have so those are all blank. But what we do have here is we have the mean incomes to compare. So you can see, actually, market income in this case was a pretty substantial portion of, imputed rent was a pretty substantial portion of overall market income. The one without imputed rent, you can see here, it took whatever variable label I gave it in Stata, which was benchmark case or market income, household per capita benchmark case, excluding imputed rent. It pulled that variable label for the column title, and then here you can see it's 6850, whereas market income, including the imputed rent, is 7900. So you can see actually it's a pretty large part of market income. That'd be one takeaway here. We can also compare the medians. Something went wrong with the standard deviation I have to double check on. And then you can look at the other summary measures. Gini, for example, it's much less equal if we do the one excluding imputed rent, which makes some sense because imputed rent should be increasing incomes at the bottom of the distribution. And then you can also look at the distribution by decile. So actually, keep in mind this is a 1% sample, so maybe this is not actually the case, but in this 1% sample at least, within the bottom 10% of the population, we have tons of zero market incomes. That apparently, though they are owner-occupiers, they don't have zero income anymore, at least a bunch of them, once we add the imputed rent to their income. Okay, so that's
Are the cells defined for each concept separately? Or are they always for market income?
No, so for this command, you can specify whatever variables you want. So these columns will be, the rest of these columns are all blank. So if you had specified, you could have specified disposable income and disposable income simulated under some policy change, and then those would be your two columns.
The deciles will be for disposable.
Sorry.
Deciles are defined for disposable income.
Yeah. Right. So whatever you specify, if you specify two variables, disposable income observed and disposable income with some policy simulation, those will be your columns, and then all of these results will be for those two variables. Because none of these results, like all of these indicators, none of them depend on ranking by a particular income concept and then doing something with another income concept. They're all, so the Gini, you only need to know what's the one income concept I specified. That determines both the income ranking and the distribution that I'm looking at. So it'll do it for whatever you asked it for, and you can specify as many variables as you want, and that'll just add as many columns of results as you asked it to. Okay, so now in these last 10 minutes, I'll show you one more command that's one of the ones that is useful for, also useful for kind of the initial analysis, and that's the CEQ des command. This one does require it does ask you for the core income concept, so it's not good for comparing, different things that I'm testing outside of those 8 core income concepts. But the advantage of this one is that it gives summary statistics also for the different fiscal intervention variables. So then the command we just looked at only does it for income concepts, whereas this one does it for various fiscal intervention variables as well. So let's go ahead and look at what that looks like. Go back to Stata. So we can look at the help file, and here you'll see, okay, we have the income concept options and the fiscal intervention options, which we didn't have in CEQ as sum. And then we have kind of the usual set of options to define survey information and various other things that I'm not going to have time to go over, but they're all described in detail in the chapter. So let's go ahead and I'm going to get rid of this one. And now let's do a CEQ DES. So we're also going to need to copy the right, we're going to need to copy sheet E1, which is where the CEQ DES results get printed. And so I should also mention in the handbook chapter, there's a table that you can look at to see what's each sheet of section E of the master workbook and what is the corresponding CEQ data package command. I think that's looking at that table is the fastest way to see that mapping. So let's go ahead and copy now sheet E1, which is where CEQ DES results are going to get placed. So that's going to be sheet E1. And then all I need to do here is specify CEQ DES. In this case, actually, unlike in CEQ Assum, I'm not going to specify the var list here. Instead, I specify each income concept in the income concept commands. So here I'm just going to specify the weight. And then I'm going to specify the income concept options. So let's just do it with two income concepts. Let's just do market income plus pensions and disposable income. And this will also illustrate that you don't need to produce all the income concepts before you ever touch the CEQ data package. A tip that a lot of countries have done, and that I think we kind of figured out when we were working with Gabriela with the initial 6 countries, was that it's very useful to go in and produce, say only have a couple income concepts, market income plus pensions and disposable income, for example, and then go start running some descriptive results and checking things, seeing, these results look kind of weird, going back and fixing that, figuring out what went wrong before you go produce kind of the whole set of results. That can be extremely useful. So that's what I'm going to illustrate now with a couple of commands. Let me just check and make sure what this variable is called. Yeah, so we have YP is the market income plus pensions, and then we have YD is disposable income. Again, I'm going to have to specify this household ID option. And I'm going to illustrate also, this also produces results for the different fiscal interventions. So let's go ahead and just look at the different direct transfers. So in the data set, we have a variable for Bolsa Familia and a variable for this in-kind milk transfer program. There's a bunch of other direct transfers too, but I'm just going to look at those two for now to illustrate. So again, in these commands, you can specify multiple options. So for the direct transfers, you just specify as many variables as there are, as many different direct transfer programs you have. You just keep specifying all those variables within the direct transfers option. And then the one thing still missing here is we're still going to have to specify what our file is called with the using. And so that'll send results directly to the master workbook. So let me do that and see what happens. All right, so it didn't. Here we go. All right, so I programmed in this issue so that we can see what are the kind of errors that can come up. So here's an error that came up that you probably can't read, but it flagged, there's 26 missing values of the disposable income variable. So these are the kind of things like you may have been programming along, creating your income concept, and not realize somewhere along the way one of your transfers somehow had missings, and so then when you added that into market income, you got to a disposable income variable that didn't have that had missing values, and so it's going to give you an error rather than try to do something that we don't know if it's right or not, so that you can actually go back and check what's going on with this issue in my data. For now, I'm just going to go ahead and drop the missing so that we can continue on. And then I'm going to run it again. And it produced the results. And so these are what the descriptive results look like. You can see this doesn't even look at any inequality and poverty. It just gives you some very basic things. What's the percent with non-zero values? So you can see, for market income and disposable income, 100%, or market income plus pensions, there's no zeros. Disposable income, there's no zeros. There would be some zeros if I did it for market income, because some people get all their income from pensions. Down here you can see, 30% have non-zeros for Bolsa Familia. All those numbers make sense. And then you can go over and see, you could also see what percent of the different income concepts is it. Bolsa Familia is about 0.6% of market income. Then we can go back and compare, how does that compare to the percent according to national accounts? It's very close, so that makes sense. So these are the kind of things you can do to compare. And then this also gives you a kind of an example of what I was talking about the accordion before. Often the accordion is by columns. Here it's by rows. So what's happening is it's just adding rows for each of the programs that I specified in the direct transfer options. And then, so for each of those, it's just going to pull the variable label that I used in my data set and then produce results for that row. So that's the CEQ des command. And I don't think I need to go through the additional commands. So let me just wrap up by first asking if there's any questions of what I went over in the CEQ Stata commands, anyone that's been using them and had some doubts about any other tips of how to best use them. Okay, so I'll just briefly say what we're doing in ongoing work. We're trying to create some standalone commands for CEQ indicators. So actually I do have a couple minutes, so let me say what the more commands are. This is just like a summary, so there are many more commands on top of the ones that I've showed you today. These are a few that kind of produce what I consider some of the core results, so I wanted to include this slide here so you can see what those are, which would be, I would say, like the ones that you would produce as the next step after you've created those. And you could still do these even with only a few of the income concepts to start seeing what all the different results look like. So CEQ Lorenz, CEQ Fiscal, and CEQ Extend, those jointly produce a lot of the main incidence and concentration results for Section D. CEQ FI produces the fiscal impoverishment indicators. And then there's also a CEQ Graph FI that will produce graphs of the different fiscal impoverishment curves that we also derive in the paper. There's CEQ Stat Sig, which assesses the statistical significance of differences in inequality and poverty across